So, dear ladies and gentlemen, warm welcome to this second edition of Financing Innovative Cleantech Conference. I'm Roman Dobrava. I'm the head of unit of the Innovation Fund at Climate Infrastructure and Environment Executive Agency of the European Commission. I'm very glad to welcome all of you here in the room, but also online. We should be many participants today, and I'm really happy that this conference takes place just now, just here. I think the timing is excellent, and yes, we will hear more today. Our objective for this event is to connect stakeholders, active or interested in clean tech investments, projects and financing, share knowledge and experience, debate how clean tech deployment can be accelerated, but also showcase benefits of these investments, look into related challenges and how they can be addressed, learn from each other. Our hope is to contribute to building a community of market players, policymakers and financiers who take concrete action towards our common goal of climate neutrality by 2050. This conference could not be more timely. Clean tech investments in the EU and across the globe are speeding up and represent significant market potential. In the same time, our policy and financing framework is rapidly evolving. And this all will be echoed in our today's agenda. Starting with welcome speeches by Kurt van den Berge and Paloma Abba Garote. Then we will look at the global trends on decarbonizing industry and power with Dr. Timur Gül in his keynote speech. And then we will outline the EU regulatory framework for clean tech investments in the session with Alexander Paco and his guests. Then we will have a lunch break, but during that we have the honor to welcome colleagues from European Investment Bank who will hold a specific session for interested project promoters, and they will present the opportunities to finance and provide advisory services to them. So please stay with us. And in the afternoon session, we move deeper into concrete business models behind projects and how clean tech investments are developed from startups to develop mature technologies and how they are financed by banking sector, by commercial banks, which are also becoming more and more important financiers in these emerging and fast-growing markets. And finally, our last session today will be devoted to symbolic signature ceremony for successful projects financed by the Innovation Fund. Maybe a few housekeeping messages. This session, the whole day, will be recorded, and the recording will be made available to all of you, including the slides. For passing your questions to today's speakers during the panel discussions, please use Slido. You see on the screen the QR code and the instructions. I will come back to this whenever we open discussion. So please watch us, stay active, pose your questions to our speakers today. I think the organizers managed to really organize a very interesting day for you, covering whole width of teams and activities that are necessary to move on with investments into clean tech today and tomorrow. And now, without further ado, I would like to pass the floor to Kurt van den Berge, Director General of European Commission's DG for Climate Action.
Thank you very much, Roman. Good morning, ladies and gentlemen. Also for me, it's a great pleasure to warmly welcome you to this second edition of the Financing Innovative Cleantech Conference, which is jointly organized by DG Klima and CINEA. And I would like to thank all the colleagues involved in the organization of this conference, for which we have received a very high number of registrations indeed. I'm told over 1,000 people who will also follow us online. And as Roman was saying, this is is really showing how timely and topical today's conference is. I think we all know that clean tech is the talk of the town, not only in Brussels, but also in Davos, in many capitals across Europe, and indeed across the world. Our president, Mrs. von der Leyen, really said that Davos earlier this week that the clean tech economy story will be written in Europe. And that's also why we gather here today, to see what is needed to make sure that this story is written in Europe. And I think the projects funded by the Innovation Fund that we will celebrate today are really an illustration of the fact that the EU has what it takes to write that story. But we need to make sure that we exploit, seize all the potential that we have, and that therefore we optimize our framework. The winners of the second large call under the Innovation Fund are the ones that we will sign contracts with today, not only symbolically. I think the contracts are also real, at least I hope. So this afternoon we will hear from the projects and especially the people behind the projects what their journey was from project ID all the way to the getting the investors backing, on the way to innovative production in a green manner. We will also hear from other market players about market opportunities that they potentially see in Europe. Let me already congratulate the grant beneficiaries who are present here today. I think they will testify that the Innovation Fund is very competitive. Some may even say frustratingly competitive. But it gives us the confidence to say that these projects not only represent true excellence and good value for money, but also they give us the confidence that these projects will deliver real results and impacts, because we have also evaluated the project proposals on their maturity for development and delivery. The projects that were selected after a long and competitive evaluation process did of course not develop in a vacuum. They are shaped by the EU and international policy initiatives, by the regulatory framework we're gradually putting into place, but also by global market conditions. And this is something that we will discuss in our morning panel, chaired by my colleague Alex Paco. We have colleagues lined up from different DGs, and I already would like to thank the colleagues for being here with us today for this discussion. It shows that this is a joined-up effort across the European Commission. This is not just DG Klima or DG Environment. Clean tech is no longer a niche activity. It is no longer something that is nice to have. It is really a must-have for our economy. It's central to the EU's competitiveness, and I would even say to our economic survival and security in the long term. That actually was also at the basis of the European Green Deal when it was launched at the end of 2019. It was launched as a new growth and investment and innovation strategy, which means that it is not only an environmental or climate policy agenda, it is at the core very much an economic and competitiveness agenda as well. Because what we wanted to do with the launch of the Green Deal is to really help strengthen the EU's competitive advantage over time, knowing that the whole world, the global market, will unavoidably need to move into clean energy, clean economic solutions. And I trust we will hear from the speaker from the International Energy Agency what the prospects are for this global market in the future. I have seen numbers. I don't know what these numbers mean because they are so astronomically high, but it is certainly something that as an entrepreneur and as a business and an investor, you will not want to miss. So what we did and continue to do under the European Green Deal is to develop an investment conducive regulatory framework that offers predictability to investors, but also exploits the scale of the single market that we have in Europe, one of the biggest markets in the world with a strong purchasing power. And I believe that the political agreements that were reached at the end of last year, especially in December, are really a sign that society and economy is ready for gearing up towards this green transition. The political agreements, notably on the ETS, emission trading system, the social climate fund, but also, for example, on CO2 on cars and many other pieces of the Fit for 55 puzzle, they were adopted much more quickly than anyone had anticipated. They will mean another boost for clean tech and the near and long-term future. And it is because we have seen in the current circumstances that the climate agenda is also very much an energy security agenda. That has become crystal clear to everyone. So that means it is also an economic imperative. And with the Repower EU plan to phase out the import of Russian fossil fuels as soon as possible, we have even increased the ambition of the European Green Deal, which is backed up by EU financial instruments, the Innovation Fund, which obviously you know, because that's why you're here today, but we also have other programs like InvestEU with a lot of innovative modalities on which we're working together with the EIB, the European Investment Bank, and other banks. And I would like to thank also the EIB for the cooperation today and over the years past and future. But we also have put in place, for example, the Next Generation EU, the post-COVID recovery plan, on which colleagues will also say a few words, which is mobilizing a lot of additional firepower as well. In addition to that, we're of course working also with industry on strategic projects through the integrated projects of common European interest, for example, on batteries and hydrogen. But I would like to say that when we launched the European Green Deal in December 2019, and then we came with a proposal to increase the climate emission reduction target to minus 55% by 2030, that happened in 2020, many asked us, where is the rest of the world? Are we not going alone? Are we the only ones in the world that will solve the planet's problem, the climate's big challenge? What does it help if Europe does it on its own? We only represent 8% of global CO2 emissions. Well, I think it's fair to say that since then the world has changed quite a bit. If we see at the development and the pace of investment that is happening in parts of the world like China, but also Japan, increasingly India that is gearing up as well, then it shows that we're no longer alone. We have to care that we're not overtaken in this competition by other parts of the world. And of course, the US is the latest that is coming not only by having rejoined the Paris Agreement, of which we're extremely happy under the President Biden's administration, but now also with the Inflation Reduction Act, which is truly called, including by the International Energy Agency, a game changer for global decarbonization. It shows very starkly that climate action is not just good for the planet, it's actually very good and profitable business, certainly more and more in the future. So with the IRA, the US is actually challenging us at our own game that we set up ourselves. That means that we will have more competition, but you all know that competition leads to excellence, leads to progress. It drives very much innovation. So what we want to do is not to confront the US on this head-on, but to really embrace the competition and to make sure that it is as much as possible on a level playing field. And I myself believe that like we got stronger on the green agenda, the Green Deal, after the COVID pandemic. Like we got stronger on the European Green Deal because of the Russian war on Ukraine, the IRA and the international competition we have for clean tech increasingly will also make Europe stronger in that regard. Our president laid out a net zero industry plan earlier this week from Davos, where she said that we will be working on the regulatory environment to make sure that we reach scale in these investments that we need, but at a much more rapid speed than we have seen so far. We will be working on financing to make sure that the finance is available rapidly in Europe for the clean tech that we all want for the future. We will be working on skills. The shortage of skilled labor is one of the challenges that most businesses tell us is hampering them in their development. So there's something to be done there to make sure that we have the skills we need for the future. And we will be working on trade policy much more active also on the green side than we've done so far. So I think it's fair to say that we will be working not only on creating this huge market, a huge demand for the clean tech, green solutions of the future in Europe, but also making sure that the supply of these solutions is coming from Europe and made in Europe and not only in other parts of the world. Let me conclude by saying that the Innovation Fund is a central part in this whole broad agenda for clean tech, green competitiveness and innovation. The December agreement on the revision of the emission trading system regulation will enhance the budget of the Innovation Fund so that we can continue funding innovative projects with small, medium and large grants. But also very importantly, it brings new modalities of competitive bidding, of auctions, if you like, to support the operational phase of projects so that we can go beyond demonstration of innovation and beyond first and second of a kind deployment. So really what we will be doing is looking at how we can use the modalities and the resources of the Innovation Fund to scale up technologies, innovative and existing technologies, including their manufacturing in Europe. And let me, in passing, say, by the way, that we still have a big call open for a budget of 3 billion euros. The call is closing on the 16th of March. So I hope that among the audience, also online, there are many who will get an appetite to look at the opportunities and use these. So ladies and gentlemen, let me conclude here by thanking you for the incredibly hard work that you're doing, very entrepreneurial. We, as European Commission, as European institutions, can provide frameworks, financing, encouragement, but it is you who make it. So you are the ones who will be creating the economy, the clean economy of the future, and that's where we come in to help you doing that. Thank you very much.
Thank you very much, Kurt, for this very nice and clear welcome speech, which very nicely sets the scene for a conference and for the following action that we will all need to follow together. Now, I'm honored to welcome our next welcome speaker, Paloma Abba-Garrote, who is Acting Director of the Climate Infrastructure and Environment Executive Agency, and pass the floor to you, Paloma.
Distinguished speakers, dear Kurt, dear colleagues, ladies and gentlemen, it is a great honor for me to be here with you today in this second edition of the Financing Innovative Clean Tech Conference. It is my first public event as Acting Director of CINEA, and it could not be any better occasion than this one. I started my professional career about 30 years ago, working in a bank in corporate and project finance, mainly dealing with projects in the energy and transport sectors. But maybe at that time, these projects were not so green. So it is fantastic to see how projects in these sectors, but also in many other industries, are becoming greener. And that's why today I am very happy to welcome you all in this conference. Today, we will discuss the framework conditions needed for accelerating clean tech investments, and we will explore how innovation embedded in the industry's business models can lead to the achievement of carbon neutrality. With a budget of about 60 billion euros up to 2027, CINEA has a key role in supporting the European Green Deal and implementing 7 European Union programs. And it is our mission, the mission of CINEA, to support you, our stakeholders, so your projects can achieve their objectives in decarbonising Europe. We also aim to establish strong partnerships, foster knowledge sharing, and create synergies between programs. We launched in the past 2 years 5 calls under the Innovation Fund, 2 for the small-scale projects and 3 for large-scale projects. And as Kurt said, 1 is still currently open. Over 3 billion euros have already been granted to low-carbon innovative projects, and 3 billion euros are available under the current call. And with this program, we extended our reach by supporting deployment of innovation into business practice at a commercial scale. I am very pleased to see the progress of the Innovation Fund, whose portfolio currently includes 53 projects and 119 beneficiaries, aiming to reach the equivalent of about 243 million tons of CO2 avoided. These projects are implemented across 16 countries, focusing on energy-intensive industries, carbon capture, use and storage, renewable energy, and energy storage. The Innovation Fund supports projects with important knock-on effect on the whole value chain. For example, in the deployment of innovative low-carbon technologies and processes in the energy-intensive industries, the production of low-carbon fuels, such as green hydrogen, the manufacturing of renewable energy production components like solar panels, heat pumps, and electrolyzers, or energy storage like batteries. These first-of-a-kind innovative projects inherently bear higher risks for project promoters. The Innovation Fund, by promoting synergies between European Union funding programs, member state support, and private financing, helps to mitigate the risk of failure of the projects. For example, it can support the production of green hydrogen, while relevant infrastructure projects such as hydrogen fueling stations can be funded by national agencies or other European Union funding programs, for example, the Connecting Europe Facility. Regulatory support from government or national, regional, or local authorities is also an important element for projects to come to maturity by accelerating the time for granting permits or licenses. The number of applications received in the past calls and your participation today shows that the industry is very keen to deploy clean tech solutions with the aim to contribute to our objective of 2050 of carbon neutrality, while at the same time stay competitive at the global level. I encourage you to use today's event to discover like-minded projects and use the opportunity to network and share good practices and inspirational thoughts. CINEA has a long track record of financing infrastructure and innovation projects in support of the European Green Deal. You can count on the agency, on all of us who are here today with you, to continue to assist you and your projects along the life cycle, to lay down together the basis for the low-carbon revolution. I hope you will all stay with us until the end, because we will finish with the signature event of the projects awarded under the Innovation Large-Scale Call of 2021, whose representatives are here with us today in the room. For this special occasion, we have added an innovative artist touch, and we will have today with us an artist, Mattia Sugamiele, who works between physical and digital interaction. He has been inspired by the projects demonstrating how innovative clean tech can set the path for a carbon-neutral society. He will work today during the conference to complete his artwork, under the inspiration sometimes of the ongoing debates. The work of Mattia will become the centerpiece of the signing ceremony, but we will discover this later. So just to conclude, thank you very much for your attention today, and I'm looking forward to today's interesting discussions. Thank you.
Thank you very much, Paloma, for another welcome speech for today, and again showcasing how many projects are already out there that actually happen, and that the clean tech is actually happening. It's not something that we just think will. It does, and it should. So now I'm really honored to welcome our next keynote speaker, who is the director of the Energy Technology Policy Division in the International Energy Agency, Dr. Timur Gül. Dr. Gül is heading the team who is behind recent and flagship Energy Technology Perspectives 2023 report, which outlines positive outlook for clean investments globally. Your report analyzed many clean tech supply chains and confirms that the race for strategic deployment of clean tech investments is already happening, representing a market potential of around $650 billion globally. So we are all very keen to listen to your presentation, Dr. Gül. Welcome, and I would like to pass the floor to you.
Yeah, thank you very much for the kind invitation to speak at the conference today. And let me first apologize that I cannot be here with you in Brussels today. I was really looking forward to this in-person meeting, but unfortunately, there are strikes in Paris today, and I did not want to take a risk. I was advised not to take a risk because I could have come too late for the event. So my name is Timur Gül. I'm the head of the Energy Technology Policy Division of the IEA, in charge of our technology work, from hydrogen to electric cars to various different other industry sector decarbonization. Head of the Energy Technology Perspectives publication that we released indeed just about a week ago, last week on Thursday, and also one of the two co-authors of our IEA Net Zero by 2050 roadmap. Let me start by just commending the European Union for the new industrial strategy that has been announced in Davos this week, and indeed Mr. van den Berge for the spirit of his speech this morning, which really resonates very strongly here with me. We also found really that the story of the new energy economy is still being written, and we look forward to working with the European Commission, everyone in Europe really, to making this happen. Now, I hope you can see my slides now. So what I would like to do now in the next 25 minutes or so is to go through some of our key observations when it comes to the industry and power sector in particular, but also then going into the supply chain work that we recently just released. I will draw on initially on our World Energy Outlook that was released last October, and then go into the Energy Technology Perspectives publication. The point of departure really is one where we are experiencing the first truly global energy crisis. Pressures on markets, of course, predate Russia's invasion of Ukraine, but its actions have really tipped the energy sector into a full-blown turmoil. Oil and gas markets are experiencing a huge amount of uncertainty, and the energy crisis is causing severe damage to the global economy, exacerbating pre-existing inflationary pressures driven by the pandemic-related pressure on supply chains and subsequent and strong and rapid recovery. The last time really that we experienced as the world a turmoil of a comparable scale were the energy shocks in the 1970s, where nearly all countries around the world saw inflation rates rising to more than 6%. Today, we're really seeing a repeat of this, but in many respects, the inflationary burst is larger and more rapid than what occurred in the 1970s, with countries now battling surging prices for energy and food. And it is, of course, the vulnerable that are suffering the most here. For the first time in decades, the number of people around the world having no access to electricity rose in 2022 against the trend that we have seen for many years. So the central question that is key to the global energy, but also to the global climate debate is, will the current energy crisis be a help or a hindrance to move towards a more sustainable and resilient energy system? A crucial test here for government responses is, of course, whether it brings additional capital into clean energy. So is it encouraging investments into lasting solutions to the crisis and not just temporary solutions? Here's a picture for clean energy investment, including not just renewable power, but also nuclear, clean fuels, grids, storage, demand-side changes like improvements to efficiency, electric vehicles, and so on. And what you can see is that for the first 5 years after the Paris Agreement, global clean energy investment was flat. Falling costs for some key technologies mean that this money went further, of course, so we get more capacity additions out of the same amount of money each year, but this was far from enough to be on track for what the Paris Agreement aims at achieving, certainly towards 1.5 degrees. It is only in 2021 that we started to see an uptake in this investment, and this momentum now, according to our analysis at least, is turbocharged by new policies. The US Inflation Reduction Act was already mentioned. Everything that is happening now in Europe, Japan's GX transformation programs, China's new clean energy targets, India's work, etc. So there's really a boost in energy investment, clean energy investment taking place even under existing policies. By 2030, we're expecting annual clean energy investment to rise above 2 trillion per year, which is more than 50% rise compared with today. One caveat here is the largest share of the increase in investment is concentrated in advanced economies, followed by China. So there's a lot of work to be done to increase the pace of investment in emerging and developing economies. Let's take a closer look now at two key sectors here, the expected progress, starting with the power sector, where we are really seeing that electricity is turning the corner, even if 2022 as a year has brought ups and downs in both directions. So on the one hand, globally, the growth story continues to be that of renewables, making another record for solar PV and wind. And on the downside, it's been a difficult year for nuclear power, particularly in Europe. This has and natural gas generation was also hit by high prices and energy security concerns. This has led to a rise of coal-fired power in Europe and continued growth in Asia. but the global rise in coal, according to our assessment, is a temporary one, given that stronger policies and competitiveness at the end of the day drive up our renewables. By 2025, our expectation is that global coal-fired generation is lower than it was in 2021, helping overall coal use to peak shortly after 2025. By 2030, coal-fired power and total coal use, in fact, are down by about 10% from the level in 2021, with renewables here being up by around 90%, solar PV and wind growing in markets around the world. It is the first time, in fact, in our assessment that renewables under existing policies are set to outpace electricity demand growth to 2030. What this means is that we are expecting a peak for global power sector emissions. They are down by 10% by 2030 and 35% by 2050 under existing policies. This is a significant reduction, 5 gigaton. It's almost 15% of global CO2 emissions today. Advanced economies here really lead the way, a reflection of the policy efforts and various structural reasons where we can expect continuing reductions that started a decade ago. Emerging markets and developing economies peak emissions for power sector before 2030 and see a 20% reduction by 2050. Much more is needed here, of course, to get on track to net zero emissions by 2050, where in our assessment, in our IEA net zero by 2050 roadmap, the power sector has to be fully decarbonized already by the year 2040 at a global level. Moving now to the industry sector as another key sector, the trends here are not as positive for industry decarbonization, certainly not under existing policies. Heavy industry in particular accounts for around 1/5 of total energy-related CO2 emissions today, predominantly from coal. But under existing policies, we see the emissions about plateauing at a global level during the 2030s. Tackling these emissions is central to the broader progress of industrial decarbonization. Of course, aligning with our net zero by 2050 scenario basically means that we need to cut around 6 gigatons of CO2 through 2050, leaving only small residual emissions by that time. The problem here, however, is that in contrast with power, where many technologies are mature and very cost-effective already, bringing down industrial emissions will require a significant degree of innovation. Many low-emission alternatives for steel, chemicals, or cement production are still not yet fully in the market and require significant additional support to be scaled up. Almost 60% of industry emission reductions to 2050, according to our IEA Net Zero by 2050 roadmap, must be achieved through technologies that are currently at demonstration and prototype stage. Now, moving on from the discussion that these are some of the key findings from our recently released World Energy Outlook, where it's important to recognize the trends under which we are operating. The pace of the transition, however, is not only determined by the pace of deployment nor of innovation, but also by the pace at which we can build out the supply chains and how secure, resilient, and sustainable they might become moving forward. Our analysis suggests that when we did a very, very detailed analysis of key elements of clean energy technology supply chains, it shows very much that today's supply chains are heavily geographically concentrated. Why is this a concern? It is a concern because concentration at any point and along any supply chain is a risk. It makes the entire supply chain vulnerable to incidents, whether they are related to natural disasters, to technical failures, to an individual country's policy choice, or to a company's decision. In the case of clean energy technologies, the discussion around such concentration risks often focuses on the mining sector, and understandably so, of course. You can see here on the slide that the top 3 producers account for the majority of global production in the case of cobalt and lithium, and around 45% for copper. But concentration is really not a question of mining alone. As we move further downstream in the supply chains, we see very high degrees of concentrations as well. Minerals must be processed and refined before they become materials that can be used, which is an activity that today shows a very similar level of geographical concentration as mining. Bulk materials are important for clean energy technology supply chains. Steel and aluminium, for example, are used to produce electric cars, wind turbines, and much more. They are produced at scales today that are orders of magnitude larger than critical materials, and they are mature markets. So we can see somewhat lower degrees of concentration among the top 3 producers compared to mining and mineral processing, but really not that much after all. There's still a significant degree of concentration. But for the manufacturing of the new and emerging clean energy technologies, we can see a very consistently high degree of geographical concentration. More than 70% of production capacity and up to 85, depending on the technology, is held by the top 3 producer countries for batteries, onshore wind, solar PV, heat pumps, and electrolyzers. And when you look at the single largest producer, then China here plays a very dominant role virtually everywhere, with the one exception being mining, where resource endowment is the critical factor and not a policy effort. But for any other step, China is really the largest producer today and is likely remain so for years to come for some of the key elements or some of the key components of solar PV and battery supply chains. For example, China already today has a huge overcapacity and operates at very low utilization rates. And as we look into the future, China is set to retain and even strengthen its position in material production as well as in the manufacturing of solar PV and particular in other areas like the manufacturing of batteries, electrolyzers and heat pumps. Other countries, including Europe, are expected to gain some market share based on announced capacity expansions. Now, let me move to the investment in clean energy technology supply chains. We need a huge expansion of technology supply, one way or another. The good news here is that really a lot of that expansion is already underway. What we have done in our Energy Technology Perspectives publication is a detailed assessment, technology by technology, region by region, of the announced projects for capacity expansions at each step in the supply chain, from mining to manufacturing. It's important here to recognize that not all of these announced projects will materialize, of course. It's announcements, but it's a good indicator of where the industry is actually being headed. So let me give you just 3 examples of the technologies that we have analyzed. First is electrolyzers. They are the technology of the day, of course. There's a huge rush to building manufacturing operations in many countries. Just 3 years ago, when we released our landmark study, The Future of Hydrogen, there was less than 3 gigawatt per year of electrolyzer manufacturing capacity installed globally. We have reached 10 gigawatt now within just 3 years, which is a very big increase for such a nascent industry. But the outlook is here really bright. To 2030, on current announcement, we are expecting manufacturing capacity for electrolyzers to exceed 100 gigawatts per year by 2030, which is half the level required by our IEA's net zero by 2050 pathway, where existing manufacturing, what we're seeing here is a significant gap, of course, but and as I said, not all of these announced manufacturing projects might see the light of the day, but it's important here to recognize that the market is really dynamic. It takes only 1 to 3 years on average to bring manufacturing facilities online, and so the project pipeline can expand further, and it can expand very rapidly. There's more good news here when you look at electric vehicle batteries, for example, where existing capacity is already high compared with today's demand, but where the announced capacity is actually very close to the levels that you require in our net zero by 2050 pathway, which is, just to put things in perspective, a scenario in which global sales of electric cars reach 60% by 2030, up from 13% that we saw last year. So a big expansion. And again, not all of these manufacturing projects might see the light of the day, but from the perspective of battery manufacturing, a transition to electric cars at a scale that is compatible with our net zero pathway is increasingly possible. Finally, for solar PV, the manufacturing capacity by 2030 could be as large as what would be required for our net zero by 2050 scenario if, and again, not everything might happen, but if all of these announced projects would get built. We analyzed many more technologies in our report, from heat pumps to others, wind offshore, etc. But the main point here is that there is a wave of investment in clean energy technology supply chains underway, much needed actually, for being able to limit the global mean temperature to 1.5 degrees. Investment in mining and processing of materials, as well as in manufacturing of clean energy technologies, must more than triple in the coming years relative to the average over the past 5 years. And some of that investment is very urgent, in particular in mining, where project lead times can be very long. But the good news here is really from our assessment that if every manufacturing plant that has been announced today gets built, then the investment that would flow into manufacturing could provide 2/3 of what is needed by 2030 to be on track for net zero by 2050. The analysis that we have carried out suggests, and the number was already quoted by Mr. Vandenberge earlier, it was also mentioned by President von der Leyen, is that the combined market opportunity for mass manufactured technologies like solar PV, like wind, EV batteries, and so on, by 2030 is around $650 billion, more than 3 times above today's levels, if governments continue to implement on time and on full their climate pledges. In terms of relative positioning, just looking at the pipeline of projects shows of the manufacturing projects suggests that China is far and away best placed today to tap into this market opportunity. China accounts for most of the current announced manufacturing capacity expansion plans to 2030 for solar PV components, for onshore wind components, and for several EV battery components. Hydrogen electrolyzers are really the main exception here, with China and the European Union each holding around 1/4 of announced manufacturing capacity for 2030, and another 10 being in the United States. And of course, China is unlikely to absorb all of its potential production domestically. When you look at the expected demand for these technologies in each country, as it is required for them to meet their own climate pledges, then it is clear that China is well positioned to remain a global leading exporter of clean energy technologies through 2030, if, and again, if, this is a big if, all announced projects materialize. There are 2 important caveats here to keep in mind. First, only a small part of the announced manufacturing projects can be considered committed, meaning only 25% of the announced projects globally for solar PV are actually under construction today or beginning construction imminently. The number is around 35% for EV batteries and less than 10% for electrolyzers. And second, policy matters. I'm sure this will be discussed throughout the day, but many of the decisions by investors and project developers will be influenced by the policy landscape. Several countries are now tailoring and in some cases reinventing their industrial strategies, which will have profound impacts. The US IRA is one example. What the EU is doing is another. Japan is working in this regard. The production-linked incentive scheme in India is another example, and of course, China's clean energy expansion plan. So I very much agree with what the President said and Mr. Vandenberg said today is, even if many projects have been announced, the story of the new energy economy that is emerging is still being written. I'd like to leave you with a final point today about the competitiveness of existing and new industry. Is a key concern, in fact, for policymakers, and it requires a careful look at the relative strengths for an effective participation in the new energy economy that is emerging. Access to lower-cost energy is one example of a competitive advantage. It can lead to lower production costs for energy and commodities. This point is not going to fully disappear with a clean energy economy. Let's take hydrogen as an example. Virtually all of the hydrogen that is produced is made from natural gas and coal, typically at a cost of around $1 to $3 per kilogram. Hydrogen is now increasingly being produced at commercial scale using electrolyzers, but such hydrogen tends to be more expensive today, of course. The production costs in our assessment are set to plummet really by 2030 from falling costs of renewables, from falling costs of electrolyzers, as well as hydrogen storage. Hydrogen produced from electrolyzers could then become competitive with conventional routes in areas with low-cost renewable electricity, even without subsidy. But just as oil and natural gas cost less to produce in some countries than in others, there will be significant variations in hydrogen production cost, mainly because of the underlying differences in the cost of renewable electricity. We've carried out very detailed geospatial modeling, actually, and it shows that production costs in 2030 could be significantly lower in countries like China, India, and the United States than in Japan, but also in Western Europe. This has knock-on effects, of course, on the cost of industrial commodities that could be produced using this hydrogen, such as primary steel production. Europe is currently at the forefront of efforts to develop and deploy innovative processes for producing steel with dramatically lower CO2 emissions, in particular hydrogen DRI. In the medium term, Europe and other high-cost regions at the innovation frontier will be able to maintain a competitive position if products in the market are differentiated according to their emission footprint. But in the longer term, more countries will be able to compete in the market for near-zero emission commodities. And then cost, again, will be critical. Commodities like steel, as you know, are traded in fiercely competitive international markets. Of course, production cost is not the only determinant of competitiveness. The size of the domestic market matters. The skills of the workforce matter. Potential synergies and spillovers between existing and new industries are other critical factors. But countries will need to carefully consider where to specialize, where and when to establish strategic partnerships, and where making direct investment in third countries can be viable alternatives. And in this regard, again, closing the loop to the initial statement, really welcoming the industrial strategy that the European Union is bringing forward, and we are all looking forward to working together with you. Thanks again for inviting me today and for listening. I wish you all the very best for today's conference. Thank you.
Thank you very much, Dr. Gül, for, I think, very insightful presentation, very clear, with the very clear messages, and also showcasing the recent report from the International Energy Agency, which is available and indeed was quoted as a global guidebook for any investor working in clean tech area. So yes, we will obviously make your presentation available, and I believe many of our participants will download and read the report, which is really guiding us in quite a positive outlook related to clean tech, but also highlighting challenges that we will need to face in the near future. Now this very nicely bridges the next session and sets the scene for the next panel discussion, where we will look into concrete EU policies and instruments that drive investments into clean technologies. It is my pleasure to introduce Alexander Paco, Director responsible for for Innovation for Low Carbon Resilient Economy Directorate of DG Climate Action. Alexander will introduce the session and will moderate the session with the speakers. So Alexander, the floor is yours.
Thank you, Roman, and good morning, colleagues. Very pleased to be with you today. I must say, very inspired by what we heard already this morning by the speakers. I take from what Dr. Gül was just explaining to us, we are really facing an extremely dynamic investment wave happening in the world. China clearly still ahead of the curve, but where I took these words, history is still being written. And I think in Europe, with the European Green Deal, with our regulatory framework and the legislation we have put in place, we are giving a clear predictability to investors. And we don't only do that. We also provide supporting instruments, financial instruments. And the main purpose of this panel today, and I think here you have lined up key colleagues within the Commission and the EIB who are working very hard together to really help support business decisions in the field of clean tech to happen really in Europe. So today, our main objective will be to present to you, to take stock on these main instruments, but also to discuss with you the way ahead, the further development. And we've heard also the President of the Commission giving this insight on this new industrial plan. So in the panel today, we have, first of all, our colleague from DG Competition, Anna Colucci, who is Director for Environment and Energy, and she will give us an insight of how state aid policy can really support this type of clean tech technologies. We will then move to our colleague, Maria Teresa Febregas, who is working in the Secretary-General in charge of the Recovery and Resilience Plan. And here you know that the EU has developed a very big fund and plan to support the EU recovery from the various crises. And she will explain us how the Repower EU in particular is going to support clean tech technologies in Europe. We will then move to Martin Spolz, who is head of unit in DG TaxUD, who will give us an insight of the taxonomy rules. And I think these are also very important drivers for making decisions on what is green investment. We will then move to our colleague, Alessandro Izzo, Director in the EIB, who will give us also a very detailed insight of what the bank is really providing as a support for investment in these technologies. And finally, our colleague from DG GROW, Jacek Kruczynski, Deputy Head of Unit, working very hard also on industrial policy in Europe from the side of DG GROW. So here you have the panel. And the purpose is to give everybody about 10-15 minutes to give you an insight of the various policies and instruments. But the most important is to be you, the dialogue with you, your questions, your remarks, because this is a field which is evolving. And we've heard already several speeches this morning giving us the way forward. Now, how to implement it, this is what we're going to speak about today. So first, Anna, the floor is yours.
Thank you very much, Alexandre, and good morning, everybody. I'm very delighted to be here this morning for this conversation. I must say, never a conference has been so timely. Congratulations for that, because indeed what we are going to discuss this morning is there on all the newspapers at the moment. It has been central in the conversation in Davos. So you see, we are part of this global discussion, and I think it's a very important one that will indeed write history, as it has been said before. And as far as competition policy, you have heard as well what President von der Leyen has said in Davos, and I'm sure that there will be questions about that. But for the moment, my presentation will mainly concentrate on the role of competition policy in fostering innovation and the Green Deal. And in the questions, we can tackle the future, if you wish. So I would say that since the creation of the European Union, in general, competition policy has contributed in preserving and fostering the Union economic prosperity. Because vigorous competition serves European consumers and all customers, being them, just households or businesses, by empowering them to make the choices in the marketplace and benefit from innovative products and services at affordable prices. And so this has been able to nurture a very dynamic and vibrant fabric of our European economy, which is made of entrepreneurs and companies of all sizes, going from the very small, the medium size, to the very big conglomerate multinational companies that we know. So maybe a little bit of jumping back in the past and remind ourselves that not long ago, in December 2019, the European Commission adopted the Green Deal communication. And the objective at that time was to become, the first continent to decarbonize by 2050 in the world. And today we heard that thank God we are not the only continent, that this has spurred ambitions elsewhere, and this is good. So we are quite happy not to be the only one. But indeed, we are at a very remarkable crossroad with the need of very profound changes. We heard what are those challenges in quantitative terms, in financial terms, but also in societal terms. And so we need very massive long-term investment to secure the green and digital transition, but also to ensure our competitiveness in an open strategic autonomy in the global context. And I would say, this was one of the questions that has already been alluded, that this is all the more true and all the more necessary in the crisis context that we are at the moment experiencing. So we need to ramp up the rollout of renewables, the ramp up of efficiency to fight climate change, and to increase our independence from fossil fuels. So when it comes to fighting climate change and protecting the environment, regulation, taxation, public funding are usually the primary tools to give the right incentives to the necessary investments. And competition policy, and in particular state aid control, also has a role to play because it complements these environmental policies and mobilize private and public funds in a cost-effective way. Just give me a few examples that are linked, for instance, to the work of the Directorate of Alexandre. For example, compliance with the state aid rule is fundamental for assessing support under the Modernization Fund, which supports the transition to climate neutrality for lower income member states. Another example is that state aid can complement support granted under the Innovation Fund for investment in innovative technologies, and you know very well those instruments. It is also important to notice that competition contributes to that drive by stimulating business to innovate, invest to succeed in the marketplace, while at the same time, and this is something that is very much on the forefront of the discussion, ensures fair conditions for European business, so preserves the level playing field and ensures the competitiveness. And here I will try shortly to give you the different instruments in state aid that can help in this respect. And we have quite a host, if I can put it this way. So we have first the guidelines on state aid for climate, environmental protection and energy, so-called CIAG, and I will give you quite a number of nicknames to remember, or acronyms. Those were adopted in January 22. They have created a flexible, fit-for-purpose enabling framework for the member states to reach the ambitious objectives of the Green Deal. They cover all technologies that can deliver the European Green Deal. They increase the flexibility of the state aid compatibility assessment, but then as a quid pro quo, has introduced a number of safeguards to ensure that aid is effectively directed to where it is necessary to improve climate and environmental protection, is limited to what is needed, and does not distort competition and the integrity of the internal market. But as I said, it's not the only set of guidelines. We have quite a few because, and I will come back to that, what we are trying is to make sure that our guidelines are fit for purpose, that they respond to the policy objectives that the European Union has, and that they adapt accordingly also to the development in the technological field. And that's why in November 2021, the Commission adopted a revised communication on the state aid rules for important projects of common European interest, so-called IPCI, another acronym. And this communication enables member states to support cross-border IPCI. This is a little bit their trademark. And it is to overcome market failures, enable breakthrough innovation in key sectors and technology, and infrastructure investment. So for a spillover for the economy at large, and also the new communication tried to facilitate as well the participation of small and medium sized enterprises by having more flexible rules for these kind of companies. And we have taken quite a number of decisions in innovative technology since 2018, thanks to the IPCI in the field of microelectronics, batteries, and more recently, 2 decisions in the hydrogen field, and there are more to come also in the hydrogen field. We have revised the framework for state aid for research, development, and innovation, this just last October. This revised framework makes it easier for member states to support research, development and innovation, including for the small and medium-sized companies, while ensuring that the competition distortion are kept to the minimum. We have introduced targeted changes to support the European Green Deal and digital transition by facilitating public-private investment in breakthrough innovation and research, as well as testing and experimentation infrastructure. And then 2 other guidelines, but I will go quickly. I don't want to monopolize too much the floor. We have all these different sectoral legislation are complemented by an horizontal one called the General Block Exemption Regulation, which lays down ex-ante compatibility condition for member states to implement state aid measures without prior notification to the Commission. And these rules as well are being revised and should be actually adopted very soon, and will be another tool in the toolbox that member states can use. Then finally, the regional state aid guidelines, those were adopted in April 2021. They enable member states to support the least favored regions, as well as regions facing transition or structural challenges, in particular just transition fund regions, in order that they adapt to the green transition. And this, again, is very important because it shows that state aid rules must continue to preserve the integrity of the internal market and take into account cohesion objectives that are enshrined in the treaties, so that we keep the European integration in a cohesive way. So coming to the conclusion, what I would like also to point out is that competition policy has also played an important role during the recent crisis and the current one, demonstrating that it has an inbuilt ability to react swiftly to changing conditions. We have adopted a temporary crisis framework just in March 2022, a few weeks after the invasion of Ukraine by Russia, to enable member states and the companies and the sectors that were severely impacted by the current geopolitical developments and the energy crisis to be supported. It allows for liquidity support. It allows to help energy-intensive consumers to be compensated for part of the increase of energy cost. And this is an important section in there as well, it actually helped member states also to accelerate the rollout of renewable technologies. So there is there as well facilitation and simplification that is allowed. And this is part of the follow-up to what President von der Leyen explained in Davos. These rules are being at the moment reviewed to ensure that they remain adequate in light of the high volatility, but also of the changing geopolitical situation that we are experiencing. So, as you can see, it's a wide range of tools, but they are adaptable. They remain effective irrespective of the crisis and the geopolitical situation. And we try to make sure that they are reviewed and adapted as much as necessary when the conditions call for that. And because this will ensure that competition policy continues to spur innovation and preserve the highly competitive social fabric and economic and market economy that we know and that we want to preserve in the internal market. So thank you very much, and I'm looking forward to the questions, obviously.
Thank you very much, Anna. And I think I take from your presentation how dynamic the stated rules are, and that really to adapt to the needs, being fit for purpose of the key political priorities. I think that's a very important takeaway, as well as the fact that many of the Innovation Fund projects are looking for support through state aids. So I think this interaction with the Innovation Fund is an important one. So I'm sure there will be, there is already interest in the room, but thank you very much, Anna. And now turning to Maria Teresa, who is going to give us more insights about the Recovery and Resilience Facility and the REPowerEU. So over to you.
Thank you. Good morning to you all, and thank you for inviting me to this event. My intention is to give you an overview of the investments and reforms that promote the green transition in the Recovery and Resilience Facility, what does exist today, and what is coming in the framework of the REPowerEU. So, as Director General van den Berg mentioned before, the Recovery and Resilience Facility is an instrument within the Next Generation EU, which was set up following the pandemic in order to recover the economies, but not only that, in order to make Europe more resilient from all points of view, being in terms of achieving climate neutrality, also promoting digital transformation, also making necessary structural reforms in order for the economy, society to become more resilient and sustainable. So for all these, member states have to present, and they have all presented, a recovery and resilience plan that has to follow some legal parameters. But one of the main pillars of the plan is precisely the green transition, and I'm going to follow on this one. Next slide, please. So in terms of the, next slide, please. In terms of the green transition, so what we have seen now that all member states have designed their plans and they have been approved by the Council, is that despite the fact that the legal requirement was that at least 37% of the investments in the plan should be devoted to the green transition, we have reached a level of 40% for climate measures, and they are legally tagged, so there are specific measures on this, so counting to 203 billion euros. And if we take into consideration also environmental measures that many times are also linked to achieving climate neutrality, we reach the level of 44%. So all in all, 251 billions are devoted in these 27 recovery and resilience plans to the green transition. What type of investments we find in these plans? So many on sustainable mobility, also on renovation and energy efficiency, on renewable energy and networks, electricity networks, biodiversity, climate adaptation, circular economy, and also on green research and development investments. But we don't have only money investments. We also have reforms, and these reforms are key in order to promote that these investments have a long-lasting impact and in order to facilitate, eliminate bottlenecks for the investment. So we have key reforms in most of the plans concerning fiscal reforms to promote clean mobility, to facilitate deployment of renewables, also on water waste management, circular economy, but then also a lot of reducing barriers, reducing bottlenecks in permitting and elements on environmental taxation. A key measure, and Martin will be talking a lot about this, is the do no significant harm, which is a criteria that is used in the plan, the fact that none of the measures being reforms investment can harm environmental objectives. And then we have, of course, some cross-border projects in the plan that, for instance, hydrogen, the IPCI on hydrogen is one of those, and also some mobility transport corridors. So in the next slide, we see a bit the breakdown of some of these investments, and you see that, and the slides will be circulated, they go from sustainable mobility, including grants and loans, because the member states were allowed also to go beyond the grants to take loans. And we go from sustainable mobility, energy efficiency, renewables, to we end also with skills, which is also a key element in order to make sure that these investments can take place. If we move to the next slide, we see that, for instance, on sustainable mobility, we go from rail to digitalization also of transport, and to ports and different types of elements that can also facilitate investments if the sustainable mobility is there to achieve the green technology and climate neutrality. So in the next slide, you see the breakout in terms of investments on renewable energy, and we see 24 billion going to the production of renewable energy and 11 to energy networks and infrastructure. So this is what does exist today in the plans. All member states have started the implementation, so I'm sure that some of you have already participated in call of tenders and even maybe signed already contracts at national level in order to implement relevant investments. All the information, well, we have a website on the European Commission, on the Recovery and Resilience Facility. You can see details on each of the plans and the links to the member states, but also at national level, we are calling member states to be very transparent on the forthcoming call for tenders for the relevant measures. Now I'm going to talk about what is coming, which is the Repower EU. So in the next slide, please, next slide. In the slide, I will present to you a bit the objectives of this new initiative, Repower EU, that has an impact in the Recovery and Resilience Facility. Why? Because additional 20 billion in grants for the member states are brought to the Recovery and Resilience Facility, meaning that member states have to develop now their Recovery and Resilience, they have to amend their Recovery and Resilience plans in order to include a Repower EU chapter. And they can use the 20 billion grants, but also loans are available to them. So here, the objectives for this specific chapter relate to the following. I mean, you will see the numbering is not ABC, but it really takes into consideration the final outcome of the discussion between the European Parliament and the Council that was reached in mid-December, just 1 week before the big package on the climate issues. So which are these objectives for the new measures that member states will have to introduce in the plan? So we see improving energy infrastructure and facilities to secure the supply needs. Of course, here we have specific elements linked to the gas, and also in some exemptions to oil. I'm sorry to say this here, no? But these are necessary in order to cover the immediate security of supply. Then we have a second one on energy efficiency in buildings and critical energy infrastructure, decarbonizing industry, increase the production uptake of sustainable biomethane, fossil-free hydrogen, so increasing the deployment of renewable energy. Third one is addressing energy poverty, and here, of course, we are thinking about energy efficient schemes for households, also for SMEs, in order to make sure that their energy savings are higher than what they can achieve today by their own. In the next slide, we see the other ones. So please, next slide. So reduction of energy demand, so energy saving equipment elements and energy saving in improving industrial processes. So the fifth one is more the issue of cross-border transmission of energy and eliminating distribution bottlenecks, also talking about electricity storage and accelerating, again, the integration of renewable energy sources, promoting zero-emission transport and also infrastructure in this area. And the last objective is accelerating the requalification, upskilling the workforce toward this green transition and also the digital elements that are in many areas linked one to each other, and to support the value chains in critical raw materials and the technologies for the green transition. So the measures that member states can include in this new REPowerEU chapter have to be new measures that start in 1st February 2022 and have to be implemented by end of 26. And member states also can do an upscale measures that do exist in their own plans. And following negotiations that are ongoing with the member states, many of them are going to scale up existing measures. So if we move to the next slide, you will see that, again, for the specific context in which we are, for some gas infrastructure facilities and exceptionally also oil, there will be a derogation of the do no significant harm principle, but it's very, very restrictive, meaning that most of the investments, most of the money will really go to clean technology. So if we go to the next slide, please. So here we see this framing also of the exception of do no significant harm, in the sense that also members will be able only to use the loans or the other EU funds, not the ones coming from the ETS auctioning. And then the last slide shows please go to the next slide, exactly. So shows the envelope for this new REPowerEU chapter. So as I highlighted, 20 billion coming from the auctioning of emission trading system allowances. Then we have still all the loans package, the 225 billion on loans for the member states that is still remaining, and many member states are counting on these loans also to increase the investments in this field, in this REPowerEU chapter. And then also member states can have access to funding coming from the Brexit Adjustment Reserve, so to an amount of 5.4 billion. So as you can see, huge investment funding is available. Member states are the ones designing the plans, so it's important that you talk to the relevant authorities at national level in order to make sure that they are aware of possible investments that you have in mind, and that they would be able then to fit into their call for tenders and the design of the measures they are implementing. So that's all from my side. I'm ready to reply to questions. Thank you.
Thank you very much, Maria Teresa. And again, you see a very telling, I would say, explanation of how much funding is available at the level of member states. And it's very much, again, for business also to come and to stimulate that type of decision by member states. But I think the figures are very telling that member states are taking these chapters extremely seriously and see also the importance of investment in this field. So thank you very much, and looking forward to also questions from your side. So now moving to Martin, over to you. It's not about directly a pot of money, but it's more about how to use the money, right? And how to stimulate investment. So over to you.
Thank you very much, Alexander, and good morning to you all. I'm coming from DG FISMA. Following the two excellent presentations from Anna and Maite, I have been asked to tell you what we have done in the area of sustainable finance, which is yet another very powerful card we have, so that we can make sure, as Kurt mentioned, that the history and the success of the clean tech can be written well in Europe. And in this area of sustainable finance, we have started working on those areas already several years ago, and I can say confidently that we are leading the world in Europe. So it would be a shame not to make advantage of that situation. If I can ask for the first slide. I will start with numbers. We already heard many numbers, but I would like to give you one number that I would like you to remember, which is at least €500 billion of additional investments on an annual basis is needed to meet the ambitious goals of the European Green Deal targets. We have several targets. This estimate, by the way, is a very conservative one. This estimate we have been actually putting together with colleagues who, in the context of the emergence of the recovery fund, but these numbers obviously will only increase over time. So again, €500 billion of additional investment needs need to be found in order to meet the target. So the ambition is very high, but again, in my presentation I will tell you that there is a good news and that we have some tools and frameworks that can actually make it happen. Next slide, please. The Sustainable Finance Framework has been established essentially 5 years ago, where we presented the first plan on how to reorient capital flows towards these sustainable investments. There were essentially 2 key objectives: to make sure that the private investors, the financial sector and businesses scale up their sustainable investments, again, to fill the gap. It is no secret to say that this gap will never be filled only by public money. I mean, public money is extremely important, but public money will never be sufficient. So the bulk of these investment needs will need to be filled by the private sector. So we wanted to make sure that the private sector is efficient and that there is a conversation between the financial sector and the businesses on how to meet these targets. And the second objective was to make sure that the financial sector itself and the businesses themselves are resilient to withstand the shocks that will inevitably come stemming from climate crisis and obviously all the environmental degradation issues we are observing. There are 3 main pillars of our strategy, which still remain to be the key pillars. The first one is EU taxonomy, and I will dive into EU taxonomy a little bit deeper, in the remaining few minutes. Then disclosures. We wanted to enhance transparency. In order to make an investment, investors need to know about the environmental credentials, not only of the project, but obviously also of the companies and what the intentions are. So disclosures by both financial sector as well as the companies are essential. And this is where we have regulated. We have now a comprehensive framework for regulation, for the disclosures. And finally, tools. This agenda is not necessarily only about regulation. We wanted to put forward some tools that investors, banks, but also businesses can make use so that they can actually deliver on what we are asking them to do. Next slide, please. Very quickly, I will not go into the depth of this, but just to say that, since we started working on this agenda back in 2018 and the Green Deal came, the ambition only increased. So we wanted to make sure that the agenda stays up to date, and we wanted to make it smarter. And there are 4 areas where we wanted to adapt the strategy. The first one is to recognize that there are different starting points that businesses, sectors, and member states have in order to deliver on the sustainability goals. And we wanted to make sure that there is recognition of also the marginal progress that is being done. So we turned into a little bit more the transition narrative, what needs to happen, how stakeholders can reach the target. Second area is inclusiveness. We wanted to make sure that this agenda also connects to retail investors, to SMEs, although they are not subject to regulation, that they are also part of the story. The third area is to make sure that not only the financial sector is resilient, but ultimately contributes to the targets of the European Green Deal. And finally, global ambition. This agenda is global, as Kurt has eloquently explained. Next slide, please. My general slide, the last general slide, will be on emphasizing that our agenda, that originally, again, focused on the resilience of the financial sector and making sure that the risks are managed, which is usually the perspective of supervisors, has been expanded to make sure that the financial sector contributes, and not only the financial sector, but businesses assess the impact of their operations on climate and on environment. And this is a very unique feature of our agenda compared to the rest of the world. In sustainable finance frameworks elsewhere, there is a lot of emphasis on the risk side, but very little emphasis on the positive contribution, on the impact that businesses and the financial sector have on climate and environment. And this is exactly where our agenda, in my view, can really provide a competitive edge. And that's also why we have started to focus on taxonomy. And here I will tell you a little bit more on taxonomy. I will spend 5 minutes if Alexander still allows. It's a challenge, I mean, to speak about taxonomy in 5 minutes, but I will try. If I can ask for the next slide, please. The taxonomy is essentially, in the first place, a classification system that brings clarity into which economic activities, which economic projects, or projects in general, can be deemed in line with our climate or environmental targets. If you wish, it's a kind of dictionary of criteria or projects in the most impactful economic sectors that would tell investors and businesses, this is, if I do these projects in this way, then I will be aligned with the targets. It's also a very useful measuring tool. It will allow investors, the banks and investors, to judge the ambition of the products that they are selling or buying. And most importantly, it can be a very useful transition tool that can help businesses and the financial sector to transition from where they are today to meet the targets. Taxonomy is not a tool that we are imposing to you to be used. So there is nowhere written in our framework that investors must invest only in the projects that are on taxonomy or must divest from other projects. But it's a guide. It's a guide, and again, beyond the transparency that we have imposed, we would like this guide to be used. Next slide, please. I will quickly take you through, that there are 6 objectives that we have set out. The first 2 are climate objectives, and these are the objectives that we have prioritized and we have already delivered in terms of the law, clarity, which economic projects can substantially contribute to climate change mitigation and climate change adaptation. We are currently working on the other 4, which you see on the slide. There are 3 main principles that have to be met for any economic activity to be deemed sustainable. The project must substantially contribute to meeting one of these 6 environmental objectives. It must not cause harm, as Maite just explained. And then there are some minimum social safeguards that have to be complied with as well. Next slide, please. As I mentioned, we have already prioritized in our work climate objectives, climate change mitigation, i.e. reduction of emissions, and climate change adaptation activities, which would allow companies to adjust to the impact of climate change. And this slide demonstrates the ambition of our project. We didn't want to focus only on activities or projects that are already green today, that are obviously in the heart of our strategy, renewables, solar power and windmills. But we wanted to capture with the taxonomy sectors that are facing the most significant challenges with the transition and with reducing emissions. So we have included in the taxonomy sectors such as manufacturing, buildings, energy efficiency, transport. These are all the sectors where the impact can be the most significant, and you will certainly find them in the climate taxonomy list. I can say that we have been quite impactful already with our work. We are covering approximately 2/3 of emissions that these sectors produce. So this is not a green niche. This really provides for a great opportunity to the businesses and to all these sectors that will have to make, obviously, change to become greener. Next slide, please. This slide is, again, fitting the agenda into the context we are talking about today. And here I wanted to say that there are many activities in the most impactful sectors that are actually very relevant for clean tech, which are renewable energies, manufacturing of hydrogen, battery storage of energy and hydrogen, building renovations, and energy efficiency measures, low carbon transport. You will find much more in the taxonomy list. We are having approximately 180 activities in the taxonomy, but these are, in our view, the most relevant ones, among others, that can really contribute to the clean tech agenda that we are discussing today. Next slide, please. I'm getting to the end. This slide sounds complicated or may look complicated, but it just shows that how taxonomy can be used as a useful transitioning tool, irrespective of the starting point that the companies are at. This slide shows that a company can, over time, increase the proportion of their activities, and also they can invest, they can make a capital expenditure, they can make an investment project that would be also recognized. So there are different ways how taxonomy can be used even if a company is not generating any single euro currently from taxonomy-aligned activities. Next slide. I'm getting to the end. I mean, we are now at a juncture where we are focusing a lot on the usability of taxonomy. I mentioned that our agenda is not only about regulation, but it should be enabling agenda, and we would like to make sure that taxonomy is a success. So we are putting a lot of efforts and a lot of emphasis on supporting stakeholders, supporting businesses, supporting the financial sector, how taxonomy can be used. From this slide, those of you who have not yet seen taxonomy, I am encouraging you to look at the website on the EU Taxonomy Compass, which will avoid you, to screen a big, thick document of the Taxonomy Delegated Act, but where you will see in a very nice interactive way which economic activities in which economic sectors can be relevant for your intentions. Next slide, please. I'm getting now to the end. Next slide, please. The next slide, if I may. The next slide will show you the other 4 environmental objectives on which we are currently working, which is circular economy, prevention of pollution, water, and biodiversity. These are the other 4 environmental objectives that the Commission has a mandate to develop. The work is ongoing. We have already received recommendations from our experts, and we are now basically at the kind of final stages of the preparation of the next stage. My final slide, where I will stop. These efforts are global, so we are working with our global partners, key jurisdictions that have also some intentions or already have developed taxonomies to make sure that there is a convergence, that there is a framework within which also global companies, global financial sector participants can operate without having too many obstacles in the cross-border business. Alexander, I will stay here. I'm, of course, very happy to answer any questions you might have. I just hope that this presentation demonstrated that there is a big opportunity that businesses and the financial sector can find in this rich agenda. Thank you.
Thank you, Martin. You did very well to manage to present this complex tool, but very important tool in such a short period of time. So thank you so much. What I take out of it, what you said at the beginning, we're not only talking about public money support, but very importantly, to have the financial sector to support this transition. And that this tool is really impactful, really making a difference. You already see it on the field. So thank you very much for that. And that's a good transition to then the financial sector and the bank, EIB. So please, Alessandro, tell us more about what the EIB is providing as support. Thank you.
Thank you, Alexander. Thank you, Alexander, and thanks everybody for the invitation and the opportunity. I will start with fundamentally looking into what are the typical risks that the sector faces, clean tech and decarbonization projects, and how these are then sort of like declined at project risk, and what are the typical instruments that, together with, a number of other mitigations and regulatory and sort of like measures that enable the industry, from a purely financing viewpoint, catalyze investments around clean tech. I think it was quite telling to see the presentation slide by Dr. Gül on the breakdown of the state of technology in the clean tech space. If you see, by rough calculation, I think around 60 or more % of the projects show a development stage of technology, which is between, piloting and sort of like early performance stage. And at 25%, if I remember the figure, is around, projects that are facing sort of market and demand, sort of like establishment risk. So if you see the challenges of this sector from a financing viewpoint are not any different than what we see mainly in innovative sectors. So technology, needs to be identified, proved. From a performance viewpoint, needs to be showing the capacity to produce at the volumes and the specifications it was designed against. There are challenges in the medium to the long term in terms of the capacity of the technology to operationally sustain the output required at the price and maintenance costs forecast. And that's a huge challenge. We see the industry facing a fundamental challenge in trying to enter as an all innovation and disruptive sort of industries and sectors, entering markets in which there are barriers to entrance, there are incumbents, there are supply chains that needs to be readjusted or disrupted, and on the demand side, the uptake of the technology and of the business proposition proposed is not tested or proven. Hence, also the pricing, of the goods or service, provided, it's very volatile. And this makes, from an investing viewpoint, the sort of like the proposition extremely challenging. Clearly, typical products like, debt-like products, available on commercial terms from the banking markets are less prone to follow this risk proposition because they are traditionally, banking, as we use the term, on a very limited sort of participation in the upside and a strong protection of the downside. The typical products that we would see in this space are products that have a capacity to absorb risk, so that have equity-like features, and that have particularly equity-like features, I would say, particular features in terms that they need to accompany the technology and the business case sort of like development and establishment throughout a probably longer period than what you would expect in other industries. If you see innovation in the software or the retail space, probably the return times are shorter. I'm saying this to prepare a bit also, the explanation of what is the product that the bank has developed most successfully together in partnership with the European Commission and previous programming period under EDP and under instruments and now under InvestEU. Please, next slide. I think, what are the general sort of like, sector risks? Obviously, our decline at project risk in 4 or 5 main sort of areas. These go from, the execution risk, which is quite high in clean tech projects compared to, and also how this risk is allocated to capital providers in typically, project finance deals or deals that, can attract debt at commercial terms. There is a full sort of like shifting of the performance execution risk to the contractors that build and then operate the facility. Here, because of the inherent sort of performance risk in the technology, you don't really find a third party to which you can fully sort of request the wrap of the execution risk. The execution and performance risk are also sort of like further exacerbated, in these projects by the nascent nature of some of the players that are involved in both the founding and sort of funding side of the ventures that carry out clean tech projects, but also on the broader ecosystem of suppliers and providers of services in terms of maintenance and also manufacturing of the technology, which in many instances are newcomers, are to the play, have smaller balance sheets. And clearly, as from the sector to the single projects, supply and offtake risk, who is going to actually produce, the critical materials and components for the technology to be manufacturing, who's going to be buying this technology are key determinants of the investment propositions. Please, next slide. What is quite important then, for us, as a provider of what we call patient investment in these, ventures is, to choose projects that have a flagship nature. Flagship not significantly meaning, in terms of volume or capex, but that fundamentally prove that a certain technology, that a certain proposition is breakthrough, is really making, that change in the ecosystem and is really disruptive for the for the market in which it's entering. And by choosing this type of projects, we fundamentally address some of the general challenges of the sector, so providing some credibility and track record to the technology choice, foreseen or pursued. That can then be scaled up or replicated in, manufacturing facilities or in other, projects outside the pilot or the first commercial scale-up project. It provides credibility to and sends a certain signaling to players coming into the arena and the ecosystem as technology provider, developer, but also financiers and service providers to the type of technology. And with the particular hat we have as being also a technical bank, so with not only an assessment of the economic and financial return of project, but also on the technical viability of the technology choices, I think we also signal and I wouldn't say the best players and the best performance in the industry. Quickly, next slide. This is a bit the track record of the bank in building up the portfolio of clean tech investments in up to 2023. I will let my colleagues further delve into these, specifically of what verticals, what sectors and what type of projects and countries we developed. I'd really like to move to the slide number 8, which is showing the product that has been developed to kind of like wrap up the type of risk that I just described. Can you move to slide number 8? 5? Yeah, I'm going. Can you move to the next slide? Next slide, please. Next slide, please. This is the product that we with some variations on the features we are mainly providing to support clean tech. It's venture debt. It's a product which has been developed as an ancillary and complementary product to venture capital investment. It's in fact in the US and now in Europe through especially the build-up of the EIB portfolio in the last 5 years become a prominent feature of available to fast growing innovative companies that have gone out of the let's say the seed phase, the first proof of concept phase, and they're facing exactly the risks that I described earlier on in terms of the general risks for the clean tech sectors and that we see in most projects, which is fundamentally requiring a certain period of time, 3, 4, 5 years, in which the project is still not producing cash flows that are foreseeable and that are financially modelable to actually provide leverage, i.e. return to a pure debt product. They require an investment which is so-called patient, i.e. it's not requiring intermingling with the corporate governance of the company, but it's requiring not to draw cash out of the company for repayment. So it's fundamentally a debt instrument that it can be tailored to the technology and to the business case of and the business model of the project, which allows fundamentally for a 5-year period or slightly longer of no repayment and very low to no payment of interest. But that's fundamentally at the end of this period, which is normally considered the period in which the technology is either proved or commercially successful. There is some market and demand, sort of like a return in terms of traction of the business proposition. The performance is there. Basically, where the business, the business case is turning positive and it's where the money is coming in finally, then the return is also required by the instrument. This way, by way of sharing some of the upside, i.e., the returns that go to equity. So, very little protection for the downside, very little, stripping of cash out of the project in the phase where most risks are concentrated, but of course, willingness to participate and share in the successful sort of like results of the venture. I do not know if I'm out of time. I could close here and then probably leave the floor leave the space to the floor for some questions specifically.
No, thank you very much, Alessandro. I think that was very useful, in particular to present the link with the risk that you highlighted at the beginning, how to manage that risk, and this venture debt instrument that you are proposing. And I'm sure there is interest in the room, and there is a dedicated session that you will have during the lunch break that your colleague will organize. So you are very much, of course, welcome to dig deeper into what is the EIB proposing. So now let's turn to our last speaker. So Jacek, over to you. You have a couple of minutes to give us, let's say, the overall industrial policy landscape we are in. And we've heard already many things. So maybe you could give us a bit of insight what are the future plans ahead. So thank you. The floor is yours.
Thank you, Alexandre, and good morning, everyone. I'm aware that I'm the 8th speaker, so I will try to be brief, and I will also say a few mildly controversial things, so maybe I will be able to capture your attention. On the industrial policy, the speech of our president was mentioned several times, and I think, being there and conducting this policy, I think what her remarks are a step change in the way this industrial policy, green industrial policy, is conducted. This is not to say that for the moment we don't have a green industrial policy. We very much do, but this is a rather hands-off approach that we have for the moment. And what are the main elements of this industrial policy? I would say first is, of course, innovation, which we are discussing today, with the Innovation Fund being at the center of that. Innovation support. I think, support is there in the sense of grant support and so on until you reach about TRL 7, 8. Then, of course, it's up to the EIB and the market to take over. And, of course, this is for a good reason. The second element of this current industrial policy are industrial alliances, and we have several of them. We have one on hydrogen, we have one on batteries, now we have a new one on solar PV, and they have produced also relatively good results in recent years. And the third element, main element of the current industrial policy are product standards under eco-design or energy labeling, where, well, the main objective here is, of course, to foster environmental excellence. But as a side effect, also, European industries often help because our European industries excel in those environmental dimensions. And between all of those elements, there is some degree of coordination, but this is rather limited. And now looking at the results of this green industrial policy, I think if you look at things like patents, things look very good. But if you actually look at the market, what is happening with those technologies, the results are rather mixed. For example, some of the key technologies, solar PV, 90% dependence on China at the moment. If you look at wind, we are still world leaders, but if you look closely, all of our 5 leading OEMs are registering heavy losses on their balance sheet for mixed results, for complex and different reasons, but also because of the way certain policies have been conducted. They are also completely dependent on, for example, permanent magnet imports from China. Then if you look at batteries, with the European Battery Alliance, we have achieved, together with EIT, InnoEnergy, very good results, more than 130 billion euros invested in battery production in recent years. But there also, with the IRA, several companies are announcing that they might shift production to the US. And we have several dependencies still on certain key components such as cathodes or lithium for the production of those batteries. And finally, heat pumps. We are also world leaders in this market, but if you look at the trade balance vis-à-vis the rest of the world, it is constantly deteriorating. So I think if we argue, as Kurt said at the beginning, that our climate transition will result in green growth and security of supply, these numbers can worry. Because security of supply, so far we mainly defined it in terms of gas dependency, but clearly for those clean technologies, there's also already a dependency or a risk of such a dependency. So now just to conclude with a few elements, picking up what our president said earlier this week. What would be the new elements in this green industrial landscape? First, she mentioned clear goals for European clean tech by 2030. And for people from my region or Roman's region, production targets sound not very good because we know with plant economy how it went. But I think you can do it in a smart way and a less smart way. And I think in this industrial policy, it is important to give businesses investment certainty, clear direction, and also a mechanism for coordinating national efforts. So in that sense, indicative targets would play an important role. Second element that the President mentioned is regulatory changes that would notably focus on faster permitting. We know that permitting is a big issue for renewables deployment. It's less of an issue for clean tech manufacturing, but it's still an issue. If you talk about developing gigafactories for batteries or solar, it can take still many years. And it's important that member states create clusters and zones where these kind of investments get special treatment. Third element that the President mentioned, and I will be careful here sitting next to Anna, targeted aid for production facilities. Of course, that creates several risks, distorting the single market notably. What I can say, what we can hear notably from the solar sector is that they need some aid to allow them to massively scale up production, because only if they massively scale up production will their products be competitive vis-à-vis Chinese producers who compete often on not fair grounds. But of course, we need strong safeguards there. And the fourth and last element I would like to mention, ensuring a level playing field vis-à-vis our foreign competitors. We have new, very powerful instruments, the Foreign Subsidies Regulation, the International Procurement Instrument. And I think there is scope to ensure that our companies have the same treatment as their competitors in China and the US. And just to say, concluding, that this is not about replacing what we have been doing so far. And there are also worries that support for innovation will be replaced with support for deployment. No, this is about complementing what we do already with additional elements. So we will be designing these new elements in the coming weeks and months, and we very much hope on your input and comments to make it right. Thank you.
Thank you. Yeah, thank you very much to the speakers. I think indeed you had a good spectrum of what is happening within the Commission and the EIB. Now you have heard many speakers. You're probably a bit tired, but I hope you can gear up, and put some questions, comments, remarks to the panelists. Please don't be shy, and I think there is a large room of potential issues that you can address. I know it's always difficult, the first to start.
Excuse me, if I may, Robert Chryz-Gawrychowski, Nordvolt Systems Poland. I have very technical questions. There was a couple of very interesting presentations. Are we going to receive a package with those materials and the slides?
Yes, of course. As I said at the beginning, the whole day will be recorded. Every participant, whether here in the room or online, will receive a link to the recording, and you will also receive the slide deck once it's processed. So don't worry, you will get everything.
Thank you.
Thank you, Annika Brack from UNIPA. A number of our projects are eagerly waiting for the regulatory framework for hydrogen. I'm wondering, to the last speaker, and thank you very much for this comprehensive overview, if we can expect also the delegated act on the criteria for green hydrogen in that package that is being prepared for February.
This will not be part of that package, but we are intensively working with DG Energy, notably, on finalizing that work.
Yes, we know, I think we all know that this is an important piece of the puzzle that still need to be presented by the Commission. So, yeah, this is something that we are working very hard on. And we know this is going to be important in terms of clarity and predictability for the hydrogen sector. Yes. So maybe I turn to online questions or comments. Roman, we have access to... Ah, voilà. So is there any possibility for DG Competition to create a framework that would facilitate collaboration between industry peers to achieve scale, speed, and efficiency? So I think, Anna, that's for you.
Ah, okay. No, thank you for this question. That, in a way, is also something that DG GROW is tackling through the alliances to a certain extent. Because as you can imagine, if you have collaboration between different economic entities, you have to make sure that this doesn't lead up to a cartel, as we call them. So when it comes to a situation where indeed and in specific sectors, there is a need for alliances, then we explain what are the rules, what can be done, what cannot be done. At the moment, we have reviewed our horizontal guidelines in the field of antitrust, where we have introduced a specific chapter on sustainability, because we received a lot of feedback from economic actors saying that there should be some flexibility there. So we have indicated in which situation this can be done. And you might have seen as well that in the discussion that is taking place at the moment as far as the joint platform for gas that the colleagues of DG ENER are putting together, this issue of how to help a consortium within such a platform, meaning different gas operator coming together, how to facilitate that while still observing competition policy and not ending up indeed in a situation of cartel. So there are tools within our regulatory framework that exist, but each time is also for the industry to assess the antitrust situation. They are usually they are used to that. They have a legal counselor to do it. But of course, there are limits to what can be done. And the necessity, the length, the scope are among the main elements that we will look in case of this kind of either alliances, consortium, or other type of collaboration.
Thank you, Anna. And maybe Jacek could come in a bit also on the alliance, because I think this is a very interesting instrument to bring together stakeholders, but also helping developing this IPCI. So maybe there is some element that you could share as experience.
Yes, I think that the main added value of the alliances is to put together indeed project promoters from across the supply chain with investors, with some kind of nudging and facilitation from the public authorities. And that's the main mechanism through which we had such good results with the Battery Alliance that we now try to replicate for solar. The IPCI link, it's always tricky because for IPCIs, DG Comp has its own processes, but still some of the elements identifying particularly innovative projects can feed into the IPCI process.
Indeed. I mean, here, when I intervened to respond to the question, I was mainly thinking about the antitrust aspect. IPCI is a state aid tool, which is another instrument of our toolbox. And there, indeed, the idea is to have different member states with different industrial actors coming together for very innovative projects that have a cross-border interest. So it's something that indeed has a big scale, and we have tried to put through the new communication the possibility to speed this up. But this is also I would say this facilitation depends also on the quality of the project that are presented to us. So the better the project, the bigger work by the member states, then homework by the member states, the easier it is for us then to approve those projects. And as I said in my presentation, the other element which is very important, because here we are often talking about, the big companies, but we shouldn't forget that, our economic fabric in a lot of member states is made of SMEs, and these need to be supported as well. And the communication on IPCI has also targeted this type of companies that need such a support.
Thank you very much, Anna. Turning back to the room now. Yes, please.
Hello, thank you for the floor. I'm Anna Uber from Context, the media Context. I've got a question for Mrs. Colucci. Do you have a more precise calendar when it comes to the announcement made by Mrs. Vestager, the revision of the temporary state aid framework? When will it start? I think the consultation started, but when will it be presented? And when it comes to taxonomy, another question, I think we're still missing criteria for forestry, for agriculture, and I think aviation, including climate-related criteria. I was wondering if you also have a calendar, maybe a bit more precise, to share with us. Thank you.
Yeah. Our Commissioner, Executive Vice President Vestager, has sent a letter to Member States to seek their views about the possible redesign or adaptation of the temporary crisis framework. And this was done last Friday. And the idea is indeed to, after having received those views, to come with a new proposal and to consult then on this concrete proposal that would amend the existing temporary crisis framework that would become then a framework in a temporary crisis and transition. So we will have a slight change of the title, and that would take into account what President von der Leyen has also presented in Davos. I think it's also important to recall that President von der Leyen said first that the modification of the state aid rules is only a limited response to the geopolitical challenges that we are facing because of the risk to the level playing field. And what she has pointed at is that this modification should be temporary and that we should adapt our rule in order to enhance speed and simplification, make easier calculation, simpler procedure, accelerated approval. But also take into account targeted aid for production, as Jacek was just mentioning, because this can have quite distortive effect, and that's why the change should be targeted and well framed. So all these elements have been put to the fore also to the member states. We are waiting for their replies, and then we will make the proposal for consultation. So I cannot give you a precise date, but you can imagine that these are pressing and important issues, so we will not waste time.
Thank you, Anna. Martin, I think there was.
Thank you, Alexander. On the second question on taxonomy, I mentioned that the current climate taxonomy list covers approximately 2/3 of emissions, and obviously there are some sectors that are not yet there, and currently there are ongoing internal discussions what to do with those, so no final decision has been taken on that, and I cannot even tell you now anything about the timeline. But what I can say is that the possibility of adding additional activities to the climate list is always there. But when I said what the next steps are, I focused on the adding of the other 4 environmental objectives to the taxonomy, which is again bulk of the work. I mean, we have to recognize that the bulk of the climate activities have been already delivered or has been delivered. Obviously, we can still consider adding more activities. The taxonomy has to be an updated and ongoing tool. So we are considering different options, but no decision has been taken yet. Thank you.
Thank you very much. We still have a little time. Yes, please.
Yes, hello, Winston Beck from Heidelberg Materials. I was just wondering if there's a definition for clean tech at the European level. Because, I mean, when we are listening to your contributions, and thanks very much for this conference and interventions, it's very much focused on hydrogen, batteries, and electric vehicles, for example. But of course, for the process industries, it's also, I mean, increased renewable energy capacity is absolutely important because we will double or even triple our electricity needs. But of course, we also need to look for our unavoidable process emissions at technologies such as CCUS. So the question would be, would CCUS fall under the clean tech definition? And also when you talk about clear goals for the rollout of clean tech by 2030, and also about targeted aid for these facilities, what kind of technologies does that actually include?
Thank you. Very good question. I don't have a final answer, but there are some references we can use. There's, for example, the Clean Technology Observatory run by DG Research, where I think you have 14 clean tech categories, including CCU. I think our starting basis, at least in DG GROW and with Commissioner Breton, is to have a wide approach. Then maybe for some specific technologies, you need to zoom in. For example, with state aid, you know, not all technologies have the same exposure to the IRA as solar or batteries. But in general, the approach is to have it wide. And then another question is regarding scope. You know, since we talk about supply chains, how far up do you go in the supply chain? For example, for windmills, are we going all the way up to steel? This is another question that we have to answer. It's dynamic.
And maybe just to add that in terms of the Innovation Fund, and I'm sure you know about the scope of the Innovation Fund, this is a pretty also broad scope, which covers both in energy-intensive industries, manufacturing of components, CCS, CCU. So we also tend to have a broad spectrum of projects that are coming and are interested by the Innovation Fund.
If I may, for the products that we deploy under InvestEU, for example, it is part of the Green Thematic Fund, so they are included.
Thank you. Any other questions? Maybe I could turn to the Slido if there is any. So I think it's a question for you. Are there precise questionnaires regarding do not significant harm per industry sectors for REPower EU financing? So, Maria Teresa.
Thank you. So we have published in 2021 the guidance on the do no significant harm for the application in the framework of the Recovery and Resilience Facility. There is a questionnaire, and this is the tool that the member states are using in order to justify that the measures comply with the do no significant harm requirements. So in our website, you will find the technical guidance on do no significant harm, and you will find that this criteria. And so member states, when they present their projects, they have to fill in this questionnaire in order to reassure us that there is no harm to the environment. Thank you.
Any other question from the room or from Slido? Yes. Does the Commission consider tax breaks as a form of support? That's maybe for you, Anna.
I can provide a kind of short reply. In the framework of measures that member states have included in their recovery and resilience plans, some member states have included tax breaks when they are very much linked to a specific type of investments, in particular, precisely, in clean technologies or investments that are linked to the green transition or the digital transition. So in the framework of the national measures, the member states are the ones designing, so it's up to them to decide whether they will bring in these measures in their own plans. Otherwise, of course, at national level, there are tax breaks that they have to comply with the relevant rules also at European level. I'm looking at our colleague from DG Competition, but they can also include some of those to be financed and supported by the Recovery and Resilience Facility. Thank you.
No, indeed, they are certainly a support, and the IRA is using it, is mainly using that kind of support. But support doesn't necessarily mean state aid, so it depends how the tax break is designed, if it is selective or not. And I can tell you that the Court of Justice has made the concept of selectivity extremely complex. So depending really on the design of the measure, we will look whether it's state aid or not, and if it's state aid, if it's compliant. But it's certainly something that we allow. It's not something that we would say it's not allowed in the EU, not at all. And so this is an instrument that member states can widely use, as much as the Americans will do for the IRA.
Thank you very much. Looking at you, Roman, I think we have to keep more or less the time for our session, allow for you to have a decent lunch, network, talk to, I think, the colleagues also around the table. Some of us will stay for lunch. Let me really thank the panelists, really very, very interesting and very good collaboration with you all. And I hand over to Roman.
Thank you, Alexander, and big thanks to all the panelists. This session only showed how wide scope Europe has at its disposal to support the deployment of clean tech. So I believe you will keep in touch with the speakers and colleagues in the Commission across all those regulatory frameworks that were discussed. We will now deserve some calories. So there is a lunch served outside in the cafeteria space. Please help yourself. But please be back, for those who are interested, exactly in 1 hour, in 1:15, because I'm really glad that the colleagues from European Investment Bank will have a lunchtime session here for those interested participants, where you will hear more about concrete support, whether in financing or in advisory support to project promoters. So please join us at 1:15. Otherwise, we will meet again for the continuation of the conference at 2 p.m. exactly here in the room. We'll have yet another 2 sessions in the afternoon, and I'm looking very much forward to meet you back, either 1:15 or at 2. And in the meantime, bon appetit. And please watch our video and slideshow that we will put on the screen in the meantime.
To meet today's energy challenges and become climate neutral by 2050, we need to speed up the clean energy transition of our economy. The Innovation Fund is one of the world's largest funding programs, investing in clean technologies to create green growth and jobs. It's 100% funded by today's heavy emitters through the EU emissions trading system. Implemented by the European Climate, Infrastructure and Environment Executive Agency, CINEA, the Innovation Fund invests in projects for the decarbonisation of energy-intensive industries, renewable energy, energy storage and carbon capture, use and storage. Located in EU member states, Norway and Iceland, it is saving millions of tonnes of greenhouse gas emissions. Meet a few of the projects. The Hybrid project is using fossil-free hydrogen to produce green steel. BCP is reusing waste heat to support the decarbonisation of flat glass production. Tango is creating Europe's largest factory producing highly innovative next-generation solar panels. Become one of them and help us reach net zero by 2050 together. Visit the Innovation Fund website today to learn more and apply to the next calls for proposals. To meet today's energy challenges and become climate neutral by 2050, we need to speed up the clean energy transition of our economy. The Innovation Fund is one of the world's largest funding programs, investing in clean technologies to create green growth and jobs. It's 100% funded by today's heavy emitters through the EU emissions trading system. Implemented by the European Climate, Infrastructure and Environment Executive Agency, CINEA, the Innovation Fund invests in projects for the decarbonisation of energy-intensive industries, renewable energy, energy storage and carbon capture, use and storage. Located in EU member states, Norway and Iceland, it is saving millions of tonnes of greenhouse gas emissions. Meet a few of the projects. The Hybrid project is using fossil-free hydrogen to produce green steel. BCP is reusing waste heat to support the decarbonisation of flat glass production. Tango is creating Europe's largest factory producing highly innovative next-generation solar panels. Become one of them and help us reach net zero by 2050 together. Visit the Innovation Fund website today to learn more and apply to the next calls for proposals. To meet today's energy challenges and become climate neutral by 2050,
Hi, everybody. Welcome back to this financing and advisory opportunity presentation by EIB. I am François Godet in replacement of Irene Galvez, who apologized for not being available. And I'm with my director colleague, Christos Stoikov, which will present on advisory. But I believe we will start on the financing, EIB financing clean tech. We believe that we've positioned ourselves as a partner of choice. We've, Alessandro this morning highlighted the different risks that are building up in for startups that and small enterprises that want to roll out new technologies. And so we believe we've quite understood well those risks, and we've designed products that we will discuss that can address them. You've seen we've built a reasonable track record with €1 billion already of financing of these technologies in sectors that we will look at in a second, with a venture debt product for really disruptors, but also a suite of products that are suitable and flexible to really look at the different structures that clients may want, depending on the type of project, the structures they're using, and of course the majority of their business and technology. We are there to support companies from the early stage of their technological development, maybe not at the prototyping or piloting phase, but definitely at the phase where they are there to roll out the demonstration of their technology. And as we heard from the Director-General of CLIMA this morning, it's important to follow up for these companies when they want to scale up and they want to mainstream their technologies, and we are there for that also. Quickly, these subjects are quite broad in their support of clean tech. Of course, all the subjects of the Innovation Fund in energy and alternative fuels are subjects of interest to the EIB, but we also stretch into circular economy, bioeconomy, and low carbon solutions for industries. These are really the core of our clean tech support focus. Oops. Now, before we drill into maybe more the structures and products that are more palatable for emerging clean tech technologies, I wanted to put out the kind of the broad spectrum of where we intervene at EIB. You will hear of advisory if we think of the early stage of the story of clean tech development. We are, the EIB is supporting the European Commission in the rollout of the EIC funding for with grants and equity injection for early disruptors. And then we follow with that program, we follow the development of new technologies with the venture debt product, and we can move on to their growth phase. And we have recently signed an agreement with Breakthrough Energy Catalyst and the European Commission to roll out the technologies in 4 specific areas, being long-term storage, DAC, sustainable aviation fuel, and green hydrogen, where we will be leveraging projects and injecting grants for their large-scale demonstration. So really from the beginning with advisory EIC all the way across to more mature technologies with project finance structures. If we think of the venture debt product, It is a product that is structured as a debt, but it's what we like to call very patient capital. So it is a structure of debt that is flexible in its amortization. Also, it has a coupon structure, but the coupon that is either cash or PEAK. So it's really looking at the emergence of a business and its technologies and its marketing of it, so that we do not have a debt structure that has high pressure on the cash flows of this early stage company. So a debt, but a flexible debt. Also a debt that is quite, compared to what the market can offer at that stage for a company, a debt that is quite long dated. So we are quite used to doing 5 to 7 years. I mentioned the amortization, either amortizing or bullet, depending on what the business plan can provide. But all this leveraging also comes with us looking at the technology and really believing in its support, and therefore our presence in transactions does bring a quite important signaling. Signaling for other investors that EIB is there to allow leveraging at a point where it's difficult for these companies to leverage. A signaling that EIB being a quite project and technical institution with capacity to understand and support technologies, that we have looked at it in its rightful regulatory and market environment. So quite some strong signaling to the market. This direct financing leverage, as I mentioned, equity, it signals to investors that we are in a right track in terms of sector and technology. And also for us, it's really a chance to look at project and bring a demonstration to the market of those technologies through their emergent and commercial scale. So really a flexible product that is well adapted to the challenges that we discussed earlier this morning, and that has been rolled out for quite a few years under predecessing programs under EDP Future Mobility, and now under the InvestEU Green Transition thematic facility. Also, for more structured projects and somewhat more advanced or established technologies, there is the project finance structure, which by definition brings in larger support, or is more designed for a larger sized project and EIB participation. It does obviously bring with more structuring, more covenants, but it has a lower pricing. I did mention the structure of the venture debt with a coupon that was flexible. What I did forget to mention is that the risk remuneration is compensated with a warrant feature, where the bank going in early with these technologies takes an upside through the warrant. Here in the project finance structure, given that the technological risk is of a different nature with more mature technologies, the structure also brings more covenants, and but with a lower margin, and therefore larger tickets can be afforded. Also, the tenors can be quite long for these type of projects. It's a product that is quite well known in the market. But I think what you need to remember from this afternoon and this presentation is that the project finance structure can also be looked at in the context of emerging clean technologies. Maybe not at their piloting phase, but at a certain stage, to get them to be mainstream, we can also look at project finance structure to support them. Here are just a few examples where these PF structure has been used, in rollout of gigafactories, in grid storage or grid services storage projects, early offshore, offshore wind, but also we've done with this structure first European floating wind farm, and therefore what I'm trying to say is that PF is, private project finance is a structure that is well known to the market, but we are able, in the right circumstances, with the right programs, to apply them to emerging clean technologies. And I'll pass on to. Sorry.
Well, if you cannot understand that one, you're not in the right place. Well, apologies for that. I guess it's something with the formatting. Okay, so look, before we go further with the presentation, hopefully we can fix it somehow. Is anyone trying to fix it? No? Okay, well, let's go like that. I'll explain. It's nothing like super complicated. It's fairly simple. So my name is Christos Stoikov. I represent the advisory department of the European Investment Bank. And as such, we mainly focus on two things, financial and technical advisory. And as a public financier, the advisory part is also an extension of our public role to develop projects for their subsequent financing. And in that respect, we have mainly three areas of operations. On one hand, we work upstream in order to support projects in their early development. We work with partners on national and international level in order to provide capacity building for local authorities, for example, and the likes. We also help out companies throughout the implementation of the project cycle and in the monitoring side. On top of that, we also produce regular studies that will help on one of the first points I mentioned in terms of capacity building and knowledge sharing. So mostly this slide should say that. And again, if you don't understand it, probably call us. We will try to explain a bit further like what we meant by each of these things. So you're going to have the context at the very end. In the meantime, there is, I understand, a questionnaire going on in Slido, and the questions that we're going to accumulate through Slido will be answered at a later stage because we're going to have a subsequent session coming up rather shortly. And if one of your questions is what the slide says, we will try to upload the right slides when these become available to all of you. But okay, let's not try to resuscitate this one. Let's move to the next one. I think next one works. Okay. All right. Look, this one is rather busy, but at least you can probably understand what it says. So, from the top, basically helicopter view of what advisory can offer, I want to dig down a bit to the more specific parts of our product offer, and then at the very end, I will show you an example of a concrete company, actually a consortium that has benefited from our support. Now, most of the advisory that is carried out linked to the Innovation Fund and NER 300 is done by a part of our team, which is called Innovation and Digital Finance Advisory, and they have three main tasks: project advisory, ecosystem development, and thematic studies. On the project advisory side, we are partnering very closely with our partners from DG Klima and the Innovation Fund, as I mentioned, NER 300 before that, which is, by the way, continuing until this year, the advisory support, but I will address that point a bit later. Ecosystem development is important for us, especially in new technologies, where you have very fluid environments where regulation is not very clear, investors' returns are not very clear, and also the local authorities and the people that are supposed to provide the right framework for such projects to emerge and happen are also not very clear in their own wish list. So, you know, building the ecosystem is something that we also do through advisory, and we do that through capacity building, meaning that we disseminate best practices. We also help to establish a very good network between our projects and the sponsors. As the European Investment Bank, we see quite a lot of projects happening around Europe, and we have technical experts and financial experts that have access to all this vast information of investors and different support schemes. And of course, if you approach us, we can also help you with finding the right counterparties. And last but not least, thematic studies are important for us. An example could be the one that we just published on hydrogen. I'm sure there are other studies all over, but we also think that this is an interesting element of our advice. And it provides also some best industry practices that you can go to our website, read through some of the studies, and if you find them relevant, of course, contact us with further questions or suggestions. Now, if we dig deeper in one of these three areas, the project advisory, I think, is the most relevant of our services for the participants in this forum. Why? Because typically on this stage, we apply our knowledge in terms of how to structure projects, both from financial and technical point of view, how to sell them to investors, and how to basically execute them in the right and correct way and monitor them. The financial industry, as you have probably noticed, is a very conservative industry. And a lot of the innovations usually involve people that invest a lot of their time, resources, aspirations in certain technologies. And very often we see that, you know, these people are eager to push these technologies forward. But unfortunately, if they are not presented in a way that is actually something that the financial sector can consume and understand and relate to, very often actually good innovative ideas fall through the cracks and don't receive the financing on time and at the scale that they needed. So in this respect, advisory can help project promoters with their business planning, with their financial modeling, with the structuring of their projects, with the governance and so forth. And I will show you a clear example of how that works. As I mentioned, that I will go back to this point on NER 300. It is a program where the funding may have ended, but the advisory component is still alive until the end of this year. So you can still apply and receive financial and technical advisory under this scheme. And by the way, thanks to our partners from the Commission, DG Klima in that case, and the Innovation Fund and NER 300, more specifically, this advice that we can provide is typically free for the final promoters. So it is covered by the budget of the EU. We have separate arrangement under the Innovation Fund, which are currently under discussion with our partners from DG Klima. The idea here is that some of the projects that apply for financing under the Innovation Fund may not receive the grant component due to certain inefficiencies in their application. And if that is something that is basically observed during the application process, some of these projects are sent to advisory services in EIB with the request that we should help them in order for them to basically be more successful in second application for grants. And this we do under the Project Development Assistance, the PDA. We have already received around 50, I think we have the number, 54 such projects. After initial screening, we have processed or in the process of taking care of these assignments for 40 of them, so around 3/4 of these projects. And if you think, okay, well, it sounds very nice, like, you know, what does he really mean? We have got the consent of one of the applicants to in the Innovation Fund to publish their case and use it. It is a consortium. It's not actually a company. It's a consortium with a very clever name, Concrete, and there are a lot of things happening in the name. So technically, they do produce something that challenges the concrete slabs. They use CO2, and which is actually, kind of calcified in a residual product from production of steel, and that's the eat part. So like they eat CO2 and they produce concrete. It's a lot of things. Like whoever came up with this, probably should focus on marketing as a career path. But more seriously, on the project itself, what happened here is they applied for financing. And because they applied as a consortium, that was a very loose structure, which financiers and investors usually have problem assimilating, because the responsibilities between the partners are not very clearly outlined. Because of that, there were also a bit of challenges in interpreting the capital expenditures planning of this project. And there were also some questions related to the emission trading schemes and how they can use certain credits from this new technology of capturing CO2, because different parts of the process were done by different partners and not in the same company. So overall, this assignment came to us and it took us 4 months. It was done by internal EIB experts, financial and technical experts, and we also engaged Roland Berger, who worked on the ETS question. Eventually, it took us 4 months. So typically, such PDAs, they take between 3 and 6 months. In this case, it took us 4 months, and eventually it was a successful project. I think when you put some meat on the bones like that, it makes what I'm saying a bit more relatable, and you can probably think of your own cases, how advisory can help. Now, if that is on your mind, like you can scan this thing here, and then you're going to go and see a bit of nice video about advisory services, what it does in animated form. So it's really fascinating stuff. But most importantly, you're going to have also our contacts, and you have my colleagues here today. Whoever is here in the room, you can talk to them. You can see them after the session. And for the people online, again, I just reiterate, there is a Slido questionnaire. You can submit your questions. You can contact us directly with any ideas or questions you might have. But whatever questions you submit to the Slido will be eventually addressed at a later stage, because we will be followed quite shortly by another panel. And that was my last slide. So thank you very much for your attention. And now, I don't know if we have a couple of minutes of questions or we have to already ramp it up, but thank you again. And thank you to Francois for stepping in for Irene and for the nice presentation. So you have the contacts of our colleagues on the lending side, you have the contacts on the advisory side, and if you have any questions, we are open to answer them. Thank you. That's the best. Yeah. So clear.
Can you turn on your mic?
Sorry, I thought I did. I'll do it again. My name is Atta. I'm from Carpfix. I have a question. Reading through some of the previous slides and also from the session earlier today, CCUS is often referred to as being part of sort of the scoping that you're looking into. But you have parentheses alternatively on the U part or the S part. So what does it mean?
It's CCU and or CCS.
So both are included?
Yes.
Thank you.
Just one thing, what we are trying to do, we're trying to get emerging technologies off the ground rolled out, and those that are out there, we're trying to scale them up. And CCU, CCS is something that we're looking at. We do not yet have a portfolio company in the subject. We're looking at a few CCU. We've looked at reactors that we're making use of carbon for alternative fuels. We do not have yet a storage. We've looked at some infrastructure for the enabling of the CCS, but yeah, that's where we are on the subject.
If there are no questions, then thank you very much. Have a good afternoon.
Thank you.
pas.
What does the art piece look like when it's finished, or is that not to be seen? It's here. It's here.
Surprise.
So are we supposed to sign the art piece?
Not directly the art piece, there will be another forex to sign. Yeah. Marta? Marta, yes.
Okay, welcome back. Dear ladies and gentlemen, welcome back to our Financing Innovative Cleantech conference. I hope you had a very good exchanges and you managed to network during the break. I think we had quite an interesting presentation from the colleagues in the EIB in the meantime, so thank you for that. I hope that many of you interested will contact the EIB colleagues for additional support or financing. And now let us move with the next session. We had very nice overview in the morning, starting with the policy context, the trends in technologies and investments in the broader term. Now let us move deeper. And in this session, we will provide concrete insights based on practical experience on the business and financial models behind cleantech investments. We will look at the various sectors, from renewables through energy-intensive industries, battery manufacturing, but we will also hear from those who are actually helping venture capital investments, startups to flourish. And obviously, and very importantly, we will be very glad to hear from how commercial banks see an opportunity for cleantech investments today and in the future. We will plunge deeper into concrete innovation fund projects, see how investors think, and learn how banks see opportunities created by emerging and fast-growing markets. As in the morning, this session is still recorded, so anyone can review it afterwards. And again, as in the morning, please, for your questions, use Slido. We will get back to them during the Q&A part of the session. First, maybe I introduce myself for those who were not there in the morning. I'm Roman Dobrava, Head of Unit for the Innovation Fund at CINEA. And it is my great honor to introduce our distinguished speakers of the panel. So let me start with our first speaker, who brings us in the world of offshore renewable energy, giving us insights on the synergy between renewable energy production and green hydrogen, and how this can speed up the green transition. In 2021, the installed offshore wind capacity in the EU was around 14 gigawatts, with the EU being global leader in manufacturing of key energy production, in manufacturing of wind turbine components and foundation and cables industry. In line with the EU strategy on offshore renewable energy, Nordsee 2 offshore wind farm project is in line with the EU targets. We will hear about that. Obviously, there is a set of challenges to be overcome to reach the targets, and our speaker, Benjamin Meetling, will shed the light on them. Benjamin holds a PhD in political science. He has held several positions in finance, commercial and management roles in renewable energy investment projects before joining Nordsee 1. And finally, he became the director of Nordsee Cluster in January 2022. So now I pass the floor to Benjamin to introduce the project and look at the challenges that you are facing.
Great, thank you very much. And I think, wait, is this the wrong direction?
Yeah. No, the other direction. Yes.
So two wrong directions actually. So,
voila.
And here we go. So sorry for that. So first, thank you very much for being here. It's a pleasure, and it's also an honor that we were granted the award here as part of the Innovation Fund, around 2 large-scale projects. So we're proud of that. My presentation, and I need to keep to the 10 minutes, is basically structured in 3 parts. The first is to explain what is Nordsee 2, what are we actually doing. The second part is shedding a light on the innovations. It's an electrolyzer, but it's also more. So we really tried to be innovative and to bring the industry forward, and we also, as part of the Nordsee cluster, which I explain later, tried to profit internally already from a sort of small scale-up of the technology. And in the end, the third part is a bit of some more general words of what we are facing these days when we try to develop the projects further. So at first, this is a North Sea cluster. Not sure whether this means anything to anybody. It's 4 project sites in the North Sea, a bit north of the island of Juist or Norderney, whoever is knowledgeable on German, whatever islands. It's not far, and you can see it from the island in 2026. So the North Sea cluster is comprising 4 projects being built by one project team. And North Sea 2, the project that is funded here, is one of them. Why do we do that? Because these projects are very, on a time scale, close together. So North Sea 2 is among the set of the first 2 projects that will come, and then there's 2 further that will come 2 years later. As you can see on the slide, the conversion date or the completion date for North Sea 2 is expected to be December 2026. And so the second phase will come in 2028. And the idea really is to use North Sea 2 to explore some technologies and then also use them for the later stage 2 years later. In general, if all these 4 projects come online, we expect to have a total power production of 6.4 million megawatt hours per year. That means we could supply, in theory, 1.6 million households. We would save, and here I get to this later, so according to our analysis on current German emission portfolio, we would save 2.7 million euros, not euros, tons CO2, sorry. Finance manager speaking about CO2. And the total investment volume of all projects is around 4 billion euros without expectation of any subsidy from energy prices like the European, the German feed-in tariff system. So as you can see on the right side, the turbines that we are supposed to build are new model turbines with 15 megawatts per turbine. So one blade is approximately 110 to 120 meters long. The rotor diameter is 236 approximately. As a comparison, you see our famous Hamburgish opera house, which looks tiny in contrast. So the second part of my presentation, as I said before, looking at the innovations. So offshore wind is principally a foundation, a turbine on top, a substation that converts the 66 kV from the turbine into the 155 kV that we need for the grid, and then of course cables to connect all of that. And we tried, except for cables, we tried to have innovations in every of these aspects. So the first one is the electrolyzer on the OSS. So our idea is to deploy an electrolyzer where we can then, with our service vessels that need to maneuver around in the wind parks, and we can fuel them with hydrogen. Most likely this needs to be accompanied by a conventional diesel engine, because the technology is not yet as advanced that it can be 100% hydrogen. On the piling of the foundation, which is usually made in a way that you have a huge concrete plate and you hammer it down, like you hammer a nail in the ground. We try to use innovative features as this vibratory piling, where you vibrate it down to create less emissions. We will use single-piece monopiles. So in the past, a monopile was hammered down, you put a transition piece on top, and then the turbine. The transition piece in-houses most of the electrical equipment that's needed, the access platform, so you can access the turbine by boat and so forth. So we are trying to do single-piece monopiles which bear the potential in the future to save also on steel, to make installation easier, and therefore also to save emissions. And in the end, we'll procure, if available, recyclable rotor blades and try to source steel, which is made from, at least 10% of it should be made from most green power. So that overall this wind park is environmentally beneficial, not only with the production of green power, but also when it's constructed. This is just some numbers on what we tend to save in terms of emissions. It's part of the presentation, and part of it has been mentioned before, so I think I skip it, or most of it, but just to see that it bears a scalability potential of up to 48 million tons of CO2 per annum. some of the risk associated with those innovations, and so that starts the more negative part of my presentation. On the innovations, the first is the permitting process. So especially on the electrolyzer, we find out that maybe it's a very German phenomenon, but I guess it's spread across Europe, that authorities are not always prone to innovations. So they of course, they have to abide by their rules. And our first hearing we had with the authorities on the electrolyzer solution, I think there were 12 people in the room from the authorities. Usually it's 1 or 2. So you can see that there's huge interest, but also they're very cautious, and it could cause us problems. Insurability is an issue, so dealing with explosive materials offshore is, of course, something that insurers don't like. With financiers, we have not touched ground yet, so it's good that we have some in the group here that can tell us more, but we fear that this could also be an obstacle. We'll start our financing processes in about a month's time. On the supply chain, we see that there's huge interest. So when you mention hydrogen, everyone's jumping on, yeah, let's do it, but not like the NIMBY phenomenon. Well, I don't do it, or I do it, but at your cost and risk and so forth. So we even don't get proper quotes on some of the innovations we try to deploy. And in the end, of course, if we get a quote, it includes huge buffers for risk. And this basically brings me to the last topic of the 3, which is the general market environment these days. So 2 years ago, when we started to prepare the project, including the innovations, basically in Germany, you had these €0 auctions where the product developers like us, we went out and we said we don't need any subsidy, we can build it. The costs were low. Suddenly the world has changed. So what you see here is basically our CAPEX and OPEX increase between 21 and today. Today it's even worse, so this was 3 months ago. So as we all know, inflation, Corona and Chinese supply restrictions, and in general a market that is very tight, whereas European countries are trying to expand, and we see this, that there's only a few suppliers in each of our main assets available at all. Of those few, there's barely anybody from Europe. So some do 1 from Europe, some do 2 from Europe. And as you can imagine, Europe was hit hard by inflation especially, so usually those are not the cheapest. So for us, it's really currently a tough situation, especially, and that's when we were speaking to German politicians, they are telling us, yeah, well, but your power prices, they are skyrocketing, so you shouldn't have an issue. That's correct for projects that are already built, but we see, and that's the right picture, that the forecast for power prices is supposed to go down. And with the market we see today, the marginal cost approach, or merit order, we think that prices will come down to a level which is low, and that will cause us problems because we build today at high prices, but we produce power when the prices might be low, and that's the challenge we are dealing with these days, with or without innovations. Yep. And by this, I conclude my presentation. Thank you very much.
Thank you very much, Benjamin, for this overview on the offshore wind in connection with hydrogen. It kind of echoes what we've heard in the morning from Dr. Gül on the vulnerability related to concentration of supply chain investment. So let's hope that the situation will move on. I just have one curious question. It's 15 megawatt turbine. It's huge. How are you addressing the challenges with that? I just can't even fathom the size of this and handling and all the related issues that you are facing.
It is so, and it is a challenge as well. So part of everything that's developing in offshore wind, it was a constant move in capacity from the first Siemens turbine, I think 3.6 megawatt, up to a lot of turbines being the 6 megawatt range. Now we are deploying 10, 11, and then moving to 50 and even beyond. It is always a new platform model, or mostly. It's new components, including blades, and we have seen in the past, and we will see failures in those turbines. But it's not only the turbines, it's then also the auxiliaries, like the foundations that need to be bigger, and then the TNI, the transport and installation. So for those huge components and for those huge foundations, you need bigger vessels. And we see also today with planning this project that, of course, the more you get to the edge of technological development, the less suppliers are there and the higher the price. So we are always trying to find the right balance to make that work.
Yeah, good luck with that, and we will come back with some additional questions during the Q&A. Now let us move to our second speaker, who will present one of the key hard-to-abate energy-intensive sectors, the cement industry. The cement industry counts about 8% of European CO2 emissions. The challenge for the cement industry is how to achieve the net zero while remaining competitive and at the forefront of new economic opportunities. Industry leaders are looking at the combination of disruptive and innovative technologies that could leap up to 48% of the total CO2 emissions reduction potential in the sector. In Carbon to Business project, which Thorsten will present, a full-scale carbon capture and use technology will be deployed in the cement plant in Germany to capture 1 million tons of CO2 emissions annually. Thorsten Hahn will give us more details on the project, and Thorsten is a CEO for the businesses at the Holcim companies in Germany, graduate in civil engineering and industrial engineering. Thorsten is also involved in various associations in the building sector. So I'm happy to pass the floor to you, Thorsten.
So thank you, first of all, Roman, for the kind introduction. And also thank you to the European Commission and to CINEA to grant this innovation fund to us, which is also a great reward for the team working on this since 2 years. And now I try to skip the... Yes, now it starts. So first of all, as you said, we are coming from the markets, and for us the aim is really to have sustainable construction in the market. That's what we are driving. It's not only decarbonization, it's also the products we want to produce with this. Said this, it means that we are validated by the Science Based Target Initiative with a net zero pledge. And by doing this, we want to lower the CO2 emissions, of course, and carbon capturing is not the only thing. So first of all, you have to do your homework, and then carbon capturing, I would say, comes on top. And now we revised our targets for 2030. We are now at below 450 kilograms per ton of cement we want to produce. So we are embedded, as you said, in the Holcim Group as a company in Germany, and for us it's really important to produce green solutions to decarbonize and to help the construction industry to decarbonize. And first of all, before you start with a project like carbon capturing, you have to know your footprint and also the CO2 footprint, how it is spread. So you all know about scope 1, 2, and 3. Scope 2 is the electrical energy we are using. So we believe that in 2030, we want to have 100% of electrical energy purchased only from renewables. Also on scope 3, we are heavily working on this. We are not just waiting until electric trucks or other possibilities come around. We are already testing them, and we try really to reduce them before the market is starting on this. But then the biggest topic what we have is the scope 1 effect. That means by producing cement, you first of all produce clinker. And clinker means that you burn limestone. If you burn limestone, then the CO2 is coming out of the limestone. So you make clinker, and this is a reactive product, which brings good concrete. But the problem is the CO2 which comes up is summing up to 44% of our total CO2 emissions. This is what we call unavoidable CO2. So this is process related, and there is no alternative at the moment to do it in a different way. So this will always happen if you want to produce cement. The other thing is the 27%, which is coming from the burning process, which you can reduce, or for example, by using biomass or by alternative fuels. So coming to our cement plant, And if you look at our cement plant, this cement plant in Lägerdorf is close to Hamburg at the North Sea, close to the North Sea. And it was founded 175 years ago. And we are always proud because 175 years ago, it was one of the most modern plant in the world. And hopefully in 2028, it will be again one of the most modern cement plants in the world. So the CO2 emissions we are having here are 1.2 million tons. So what are we doing? In short, we are producing, having a new kiln line, which is now kiln line number 12. After 175 years, I think this is only the 12th kiln line we have. But before we start in capturing, I said, it is really important for us that we really reduce our emissions by using other levers which are easier. One lever is, for example, using less concrete, build more. We say build more with less. So using less resources and build more housing with less concrete inside. But also when we say that cement is built with, is produced out of clinker, you can also add mineral components. So for example, we use mainly slag from the steel industry, but in the future we want to go more into circularity. That means we want to use mineral components coming from demolished housing, from the concrete out of demolished houses. So then you have reduced your clinker factor, which is really important, but in the end you really have to capture it, and this is what the project is about. So what makes our project special? So first of all, we want to capture 1.1 million ton, and we convert the full plant, that really the whole plant 100% is captured, the CO2. And this we are doing by a production with an oxy-fuel. So oxy-fuel means that instead of using ambient air for our firing process, we use pure oxygen in the oxy-fuel project. Where is the oxygen coming from? So first of all, we are located, as I said, in the North Sea, and we have windmill farms there, we have renewables, and we want to go into hydrogen and with electrolyzers, and by splitting water into hydrogen, there is also oxygen, pure oxygen coming from. So we use this pure oxygen, it goes into our cement plant, and by using this, that means the advantage out of this is the process of capturing is that CO2 is enriched already very high. So the purity is already very high, and in the end we will have a purity of 99%, which is food grade compatible. So you can have it also in your water and so on. And this, we believe, is a raw material. We really see that CO2, carbon, is a raw material also in the future. And then later on, with the CO2 and with the hydrogen, we want to produce methanol, which is the pathway going to the chemical industry, but also for the to produce fuels, synthetic fuels out of it. For example, for the aviation industry or for the marine industry. So giving you some facts on the project. So the capex is around 500 million, and because of the increase, what we heard from Benjamin already, we planned 500 including the funding. Now it's 500 on top with funding. That's with the increase coming up, but that's not the case. Then clinker, with 1.5 million tons clinker we are producing. The CO2 amount which we are capturing is 1.2 million tons. The idea is that the CO2 sales price, so we want to sell the CO2 into the system, equals the CO2 purchase price. And the the negative thing is the consumption of electrical energy will go up from today 28 megawatt up to 100 megawatt, which is still, compared to other capturing alternatives, a low increase, but it is 3 times more than we have today. So what is for us really important is CO2 will be a feedstock in the future. So that means by, for example, for the chemical industry, if they want to fade out, if they want to be CO2 neutral in 2050, they have to fade out crude oil and natural gas. And CO2, we believe, is a possibility to feed them with carbon. So when you see on the left side, the demand in e-methanols over the time will rise dramatically. So there is a huge demand of methanol, which we can provide with, for example, with our project. And this is really important because we are close to an airport in Hamburg and we are close to the sea where we could feed methanol for harbors while ships are today converted into methanol burning processes. On the other hand, if you see, which is much more important, is the demand for until 2050 for pure carbon will rise to 1 billion ton per year. So there will be a huge market for carbon, and CO2 in a high purity is carbon. So we can transfer our whole industry into a carbon recycling, into a circular economy for carbon use. And this is for me really important, and I think this we have to invest, that we make it happen, that we go into a carbon circular economy. So that's why we say that is a new sustainable value chains we are able to produce and to create. And for us, it is not only that we say that decarbonization is for us important to reach CO2 neutrality. On the other hand, what we heard today is energy. So we are also providing energy to other sectors, and energy independence, especially here in Europe, we heard this morning, is really important for us. And this is also what we are able to create with this project. So in the end, our project, which is dark red in this map, is embedded in a bigger project, creating really a value chain in this hub. And the value chain is done by renewables coming from the North Sea, by producing hydrogen, using the hydrogen to produce methanol, and later on with methanol, there you can use it for everything. I always said methanol could be the new crude oil for the industry. So that's really the thing, and from this 1.2 million tons of CO2, we can produce 900,000 tons of e-methanols in the future. So thank you very much.
Thank you very much, Thorsten. Doing more with less, we've heard several times, and I think it's very, very true. I would have just one maybe immediate question to you. It looks there are many cement plants in Europe. Could the setup that you are building in Germany be a sort of a blueprint for cement industry for the future?
I think it can and it should, and it's not only because that you can adapt oxy-fuel project. I think you can build oxy-fuel plants all over Europe, but for me it's more important that we go into a carbon capturing mode, that we say it is possible to have carbon capturing in the future, and we work in all three plants I'm responsible for, we work on projects for carbon capturing. So the way we do it will be different from plant to plant because you have to apply the best solution for your plant, and that it has to do with the environment you are in. But I guess especially plants which are located at the coastline, and we have a lot of cement plants in Europe at the coastline, they are really good to create this hub for energy transition and also for carbon capturing.
Thank you. Thank you very much. And let's move to the next area or sector of clean tech, I may say, supply chain investments. We are moving now towards the batteries. Our next speaker will shed some lights on the key topic of the energy transition, the sustainability of energy, of electricity transport. We've seen that despite the coronavirus pandemic and significant supply disruptions, Europe still continued its efforts and succeeded in anchoring its position as a frontrunner in the global sustainable battery market. So far, more than 100 industrial battery projects are being developed across EU member states, with some 20 battery cells gigafactories. The EU is set to meet 69% and 89% of its increasing demand for batteries by 2025 and 2030, respectively, and should be capable of producing batteries for up to 1 million cars per year, with current pace of investment. The annual added value created by the battery industry would be an estimated around 600 billion by 2030. This is a bit of a statistics. Now we are getting into real framework in which the relief project will be operating. Our next speaker is Julien Masson, who is a strategy and business development executive with a long-term experience in mines, metals, and energy industries. You have been working in the large scope of commodities, including metals and energy. So Julien is a group strategy director of Eramet, and I'm happy to pass the floor to you.
Thank you. Thank you for having me today. It's a great pleasure to be here. Thank you also for being selected into the Innovation Fund. So I'm going to talk about the batteries ecosystem, batteries supply chain, and presenting you a little bit of what we do and why we are in this today. Just a very brief word about Eramet. So Eramet is a leading company in mining and metals. We are providing metals for everyday life, including metals for steel, for infrastructures and buildings, nickel for stainless steel that we use in everyday appliances, and mineral sands that you have in your paints, in your ceramics, and so on. So we are almost everywhere where you have metals. And we are developing in metals for the energy transition. And the energy transition at Eramet is critical metals for batteries, which means lithium. I think we had some words about it this morning. Nickel and cobalt for batteries. And the topic of today is battery recycling. Just a few words. I mean, you all know that we are in front of a large revolution. We've been living in an era of oil for more than 100 years. And we are very quickly transitioning for the era of metals that are going to fuel this energy transition. So I draw a small picture of, let's say, a normal car that's currently in the street, and that's going to be more and more in the street, obviously. And to do this car, you need a lot of metals, 50 kilograms of pure nickel, 50 kilograms almost of lithium. It probably doesn't say too much to many of you, but it's for us in the mining and metals industry, it's a lot. And to give you a little bit more of perspective, I show the increase of demand for all these metals. For example, for nickel, we are going to need twice more nickel in less than 10 years than what we needed in 2020, and almost 4 times in 2040. So it's a huge increase. It's a lot of investments, a lot of projects that need to be done. And it's about the same for cobalt, and for lithium it's even a larger increase, because lithium is a rather new commodity in the way that it's used. So it's 6 times more lithium is needed in less than 10 years. So a lot of metals need to be provided to fuel the energy transition. So this is our mission, this is what we are doing, but obviously taking only raw material won't work for very long. Just a brief word also to introduce you with the value chain, because probably not everybody is aware of how it works, but there are several steps. It's a long value chain between the raw materials and the batteries at the end. So very briefly, you need to transform that to produce metals. Then you need some refining to have very pure metals that are needed for these applications. And then you produce some cathode active materials. Then there are the battery manufacturing plants that most people know about, and then obviously the car makers. And what we're trying to do is to close the loop by providing battery recycling solutions to reintroduce those metals that were produced at the beginning directly into the value chain, and then saving a lot of obviously of CO2, but also raw materials in this loop. The main difference, I said, we are switching from the era of oil to the era of metals, but the big difference is that once you've brought these metals into your car, they are there almost forever. It's not like oil, when you burn it, it's disappear and it's gone. So that's the mission of the recycling. It will have a lower CO2 impact. It will also be positive in terms of sovereignty, because those metals will be basically mine. It's an urban mine, as we say. So you have there in Europe, and it also added value in Europe in terms of metals and value. So that's where we are today. At the beginning, there won't be a lot of batteries, end-of-life batteries to recycle, and most of the feedstock will be from the production scraps, so plants that will have scraps that we need to recycle. But progressively, as we go further, it will be more and more end-of-life batteries. Typically, in 2040, it will be a lot of metal. So it's a large market. Just the question is how we do get there. Between now and 2030, there's still a lot of question mark. Very briefly, also not to get into too much details, but it's also within the recycling space. Also, it's a lot of different capacities to have. You need a very efficient logistics. It's a large part of the recycling cost. You need to dismantle. You need to produce an intermediary product that we call black mass. I won't go too much into the details today. And then you need to refine with a quite complex hydrometallurgy process, where Ahmed has a lot of experience and knowledge, and developed some patent, and which is quite innovative, and the whole value chain itself is innovative in a way that it's almost non-existing today, and so a lot has to be done. But it's a work that needs to be done with several partners, and we're working with car manufacturers, with logistics, with gigafactories, and also for all the value chain. So it's an integrated effort. Our project, the Relief project, that has been granted this innovation fund, I believe we have a lot of the successful pieces to make it happen. First of all, and I heard this morning, all of this innovation project have all execution risks, so you need to be really mastering the technology. It's a lot of R&D. We've been working on this topic for a long time. You need there are also very ambitious targets from the European Union on the efficiency that need to be achieved, so we are quite confident we will do that, but it's a lot of work as well. More importantly also, or at least as much as important, we need to develop partnership to make sure that we have the feedstock to recycle, because it's good to have a very efficient and nice plant. If you don't have anything to put in there, it's not very useful. We need to work to develop ecosystems, battery clusters, so just to make all the actors of this value chain working together, and it's easier to do if they are all located into a relatively small area, and there are a lot of synergies to work together, not only logistics but also technical collocation synergies, so it's quite important as well. And the last point is also the difficulty in this kind of innovation programs is how to start, because basically today there is almost nothing, no battery to recycle. We've seen that in 10 years there will be a lot, but the transition period is not so easy. You don't want to make a too small plant because you won't be efficient, but you don't want to make too large plants and have nothing to put in that. So that's the difficult part, and that's where we need some support to initiate the chain, and we're quite happy to have this innovation fund, because it's really what we need to start the pump, and then I think it will work by itself, but that's very important to be supported at the beginning. So thank you. Thank you for the innovation fund for their support. Some picture of our research lab that is currently working on these projects. And happy to answer questions after the Q&A session. Thank you.
Thank you very much. Julian? Very, very interesting. And again, echoing the message and the presentation that we heard also in the morning about the importance to address the scarcity of the critical materials and the feedstock that are important for clean tech, where your project is indeed at the forefront, making sure that the recycling is becoming a normal part of new business models that are emerging, which is not easy. I can imagine all the challenges that you listed. But maybe just to react immediately, we also heard in the morning that it's critical and essential that there are strategic partnership built across Europe between different companies, between different partners, building on competitive advantages and positioning, strategic positioning. I think we've heard that also from IEA. So what do you see as the biggest challenge to build European Lion batteries recycling value chain?
Well, as you said, there are many challenges, but clearly the biggest challenge is that we are starting basically a new business. There is almost no recycling business for batteries today, and we are starting from a blank page. So I'm used to businesses where you already have an existing industry, where you know the prices, you know how it's going to work. Here, it's not just adding a disruptive technology, it's really creating a business. So it has a lot of challenges. You need to work with all the ecosystem and work together and basically create a new business model. Again, no prices reference, no commercial agreements, no logistics. So it's really not only being innovative in terms of technology, but also in terms of business models. And you do that all together with all the value chain. So it's the biggest challenge of all for this.
So the complexity and the scale of that. I believe we will be providing even more support in the current call of the Innovation Town, which is currently open, with the 3 new specific topics addressing electrification of industry and hydrogen, addressing exactly manufacturing of clean tech, including batteries, recycling, heat pumps, electrolyzers, and so on, but also new pilots that will address lower, let's say, TRL placed projects. But we still continue supporting also the cross-cutting projects, complex and large-scale investments are the, let's say, our general topic that continues. And with 3 billion, let's hope we will see more projects that may also link strategically with yours, because I understand that this is also a big question mark for the future development and scaling up. And this is, I think, a good bridge to our next speaker. We will move from large-scale industries now towards startups and innovative companies that are, I think, necessary and essential for our longer path towards sustainability and competitiveness. The EIT Inno Energy was established in 2010 as European Public-Private Partnership. It's an investor and accelerator in sustainable energy innovation with a portfolio of more than 380 startups that have been supported. And you have a very broad scale of activities that you support. According to the statistics I have here, you have already invested 560 million euro in more than 480 products. And the innovation projects alone have forecasted sales amounting to 5.3 billion euro. So that shows the growth potential, but probably we will hear more from our next speaker, Diego Pavia, who is the CEO of EIT Inno Energy, graduated as an electrical engineer, and I guess a long-term professional in business, finance, investment. So Diego, very glad to pass you the floor.
Thank you, Roman. So what I want in the next 10 minutes is to share the lessons learned over the last 12 years. And Roman said that, yeah, we are supporting very early stage, but many of those early stage today, they are industrial champions, the likes of Northvolt, the likes of H2 Green Steel, the likes of Verkors. So again, lessons learned after 12 years, you learn more from the mistakes, we have done a lot, but also for the successes. And this is my next 10-minute speech. And only on, just to complement what Julien said, when I have to tell my mother what is recycling of batteries, because that's the way we have to present those things to the general public. Well, Mom, your children, your grandchildren, the children of your grandchildren, they will be using the same metals on and again to power their cars. And then she gets it, why recycling is relevant. So one thing we should be doing for getting not only financing support, but also citizen support is to explain simply what we're doing. Sometimes we don't. We get a bit too complicated. So lessons learned, again, a track record. We have got 4 unicorns in clean tech in our portfolio. In the world, there are 31. So we believe we have cracked the nut of how to support from early stage to industrial champions. And that's why the title of my presentation is not financing, it's investment. Because financing is definitely a must, but any business case is as strong as the weakest of the different dimensions of the business case. And financing is normally not the weakest of all those things. So I heard that IRA has already been touched extensively, but still, that's why the difference between investment and financing. Today, there is a big carrot out there in the other part of the pond to capture our industrial champions. And if those champions are captured, then we'll not have a deal flow to invest in. So we better counteract what they are offering over the pond. So it's not only about financing, it's about something else. And just a line, as you can see in the screen, so any Peter Norvolt or Benoît Vercors or Nemanja Levenis, they have a big carrot of $35 a kilowatt hour, when the cost of producing today is 130. So any boardroom will decide to go over the pond if it were only about financing. And that's my first key message today. Investment is not only about financing, it's about other things. And we have to keep our champions, not by matching only the carrots of outside, but by enabling a very business-friendly environment to make their dreams become true. And this is what we are doing in all our boards in the 180 companies where we are today a shareholder. To answer to those two questions, what do we need to keep you in here and not going to the US or other because of financing? And then we answer basically the bubbles that you see in this slide. And this is what we bring as energy to the table in all those industrial, capex-heavy, clean tech investments. The message is any business case or any boardroom will take a decision based on the weakest and the strongest of those bubbles. And the decision, again, will be based on this. I'm going to cover that. So you see on the top and top left, lowest capex, lowest opex. That's the first thing. And this morning you heard a lot about financial schemes that makes this attractive. But that's not the only thing. Then you have other things. It's where we believe we excel as energy, the sweet spot. I take one of them, sustainable governance and values. I take the example, I will take an example of a clear case so we understand what is behind. So the battery regulation that has been approved in Europe the 9th of December last year, after 2 years of negotiations. That's the best regulation ever, if you can ask me, around the world. And it puts not the competitiveness of Europe based on pricing and costing, but based on circularity, traceability, and sustainability. And why is that relevant? Why that will make that the gigafactories will stay in Europe? Why Eramet will be in Europe? Because the heavy lifting of financing the cases comes from the private sector, and we have ING afterwards. And those banks, those private equities, they will be measured of how green their assets under management are. And they will not be investing in a crappy gigafactory that is not traceable, not sustainable, not circular. So this tool that we Europeans, we have is extremely relevant for making an investment case investable, financeable, bankable in the long run. And that's a plus that we have to leverage to keep our industrial champions here. The second thing, training. Today, again, I keep on in the battery world, today there are not resources, there are not knowledgeable people to operate all those gigafactories, processing of mines, refining, recycling. So if we develop those skills, then we'll be helping our industrials to stay in Europe. Again, a soft thing that makes investment and financing stay here and workable. Third thing, robust domestic supply chain. We just heard from Julien that one of the critical things in the battery value chain is lithium, manganese, nickel, and cobalt that today are basically sourced from outside. Well, what we did as energy is, now we are supporting junior miners in Europe to do lithium and manganese. Because that's also the risks, the investment decisions of those gigafactories. Again, I keep with the same example, just to make things clear. So 3 systemic supports that is not targeted to one case, is targeted to many cases. And this is where we have a uniqueness and that we can play around. And the fourth one, shortest FID and SOP. Well, permitting was also covered by one of the panelists, but then something that we did with Norvolt. Norvolt is 58 hectares in the north of Sweden, in Skellefteå. 58 hectares that were cut, where people were walking the dog, where people were picking the mushrooms, and we just heard the first speaker saying about the NIMBYs. Well, we spend a lot of time just talking to all the municipality, 8 town halls, 800 people around, because at the end you need to have the acceptance of citizens to make the case happen. Why I'm making those examples? Because financing is important, but any case is as strong as the weakest of the bubbles that you see in the screen. And this is what we Energy were doing since 12 years, to address mainly the other bubbles, to make the financiers, to make the EIB, to make the Russian fund, to make the banks comfortable that they are investing in the proper, the risk cases. And that is where we Europeans, we can excel. So that was one of my main messages. I will not cover the rest of the slides, I guess you will be getting them. And what is in the middle of this slide, that's my last slide. So because of what we do, the Commission has awarded us the mandate to lead 2 strategic value chains. The battery one since 2018 and the PV one since December. So, ladies and gentlemen, we Europeans, that today we are 98% dependent on PV imports, ingots, wafers, cells, blah, blah. By 3 years' time, in 2025, we're going to be 60% self-sufficient and resilient. Again, leveraging the same dimensions I just spoke about in the bubbles for batteries. So the same trick we did for batteries, we all are going to do that for PV. Thank you.
Many thanks, Diego, for this, I think, very inspirational presentation, which kind of echoes the American style. Yes, we can, and yes, we do. And this comes through your messages very clearly, despite the challenges that obviously we are facing. Apologize my ignorance, but what is a unicorn?
A unicorn is a non-listed, because there are many companies that are more than 1 billion, is a non-listed 1 billion valuation of a company. So today, I don't know, Renault is 11 billion, but that's not a unicorn because it's listed. Norvolt is 18 billion, 18, not listed, so that's a decacorn.
I just wanted to come back on your positioning on Europe there, because now it makes obviously very plastic picture.
So in the world, there are 31 of those unicorns. We have got 4 in our portfolio. So maybe we're doing things right. And the right thing is the bubbles.
Okay, maybe just one more immediate question, reaction. We've heard something or a lot about the need for financial support. You are actually stressing the importance of non-financial elements. And from your experience, what is the weight of one against the other, and how do you see them changing, these weights, over time?
So to answer Roman on this, since we are supporting from very early stage to industrial scale, then the weight of different factors varies. Okay, so citizen acceptance, so when you are just in the lab, you don't care, so it's not relevant. When you go to and you cut 58 hectares, you do care, because citizens will not accept. So all those dimensions, they take different weights, but you have to plan for those to be addressed from the very first day. So when you select where you're going to erect your next gigafactory, it's not about the cost of energy. It's very nice, in Sweden. It's not because you have got access to raw materials. No, it's also those things. So you better have those criteria up front, knowing the downstream.
Yes, thank you. And this brings us, I think, quite nicely to our last speaker for this session. And we move from investor side to the financier side. Very important part of the picture. We've heard something from the colleagues from the European Investment Bank. Now we move to commercial banking. And we will hear more about how banks are supporting their clients in developing new energy technologies, clean technologies in Europe. And I'm very happy to welcome Henry Rushton, who is a director for energy sector, I believe, in the ING. And especially you have been a long-term member of the ING's hydrogen team, and also working in many other positions in the sector in and out Europe. So we will hear from you now about how ING sees the opportunities and challenges for clean tech investments in Europe. Henry, over to you.
Thank you, Roman, very much for the kind introduction and also for the invitation to speak with you all today. Let me just get my slides up first. So I'm here today representing ING Bank. We are a leading financer and advisor to the energy sector globally. Energy transition sits at the heart of what we do. Now, what does that mean? It sounds like a bit of a vague statement, but what it means is that we have committed to align our own energy portfolio, our lending portfolio, with that of the Paris goal, so net zero by 2050. We call that our Terra approach. It also means that we have taken certain steps, concrete steps, to align our portfolio. So we announced last year that we no longer finance new upstream greenfield oil and gas projects. It also means that we have committed to doubling over the next decade our renewable lending portfolio, specifically wind and solar. And it also means that we are one of the leading banks and the forerunners of new energy technologies. And the new energy technologies division was set up now almost 3 years ago, focusing on 3 pillars: hydrogen, carbon capture, storage, and utilization, as well as energy storage, battery storage, stationary, and EV. I'm here today specifically representing our hydrogen activities, and I'll talk a little bit about bankability considerations, which will be focused more on hydrogen, but actually I think there are a lot of parallels across bankability considerations across the new energy technologies and financing clean technology. Just to point out that ING has a commitment to financing new energy technologies. It's not just something that we say. We have a dedicated envelope of financing at the moment of 650 million euros to finance these projects. And I think to Diego's point, I'm glad you said that you didn't think that the weakest link was the finance, and I would agree, because I think that ING is not the only commercial bank, clearly, that is focusing on new energy technologies and clean tech financing. And there is a real willingness, I would say, amongst banks such as ING to finance this sector. That doesn't mean that our risk considerations go out the window when we're looking at financing these projects, but it does indicate that there is a real willingness to look more flexibly and more seriously at these technologies. Here we just, I couldn't speak without selling our product a little bit, but we have a dedicated, clearly team focusing on the energy sector that covers both lending, project finance lending, as well as a dedicated team providing advisory services, as well as our in-house team who have a background in engineering and clearly can advise us within ING on the more technical aspects of these new energy technologies, as well as the existing technologies within the energy sector. I just spend a bit of time talking about hydrogen in particular, and then I will move on to the bankability considerations. Here we have an overview of the cost differential between hydrogen as it's produced today through steam methane reforming from fossil fuel derived hydrogen, and that of electrolytic renewably sourced hydrogen. We don't need to go through the numbers, but I was pleased to hear today that the IEA, that our analysis agrees with the IEA that we expect to see cost parity with renewably sourced low carbon hydrogen by 2030. Now, why is that relevant? We've now got 7 years until 2030. And from our perspective, this tells us that in that intervening period, government intervention, public funding will play a key role in bridging that gap. We talk a lot about, or rather I hear a lot about the sort of the chicken and egg problem between developers not wanting to develop hydrogen projects because there are no offtake contracts in place, and off-takers not saying that they want to sign up to offtake contracts because they expect the price to come down over time. I personally don't think that there is a chicken and egg problem. I think it's called risk sharing, and I think it's existed since the beginning of project financing frankly, any sector within energy finance. And if you only look at the development of the LNG market 70 years ago, which was very capital intensive, a lot of upfront capital required, technologically unknown at the time, and that developed into the industry it is today through people taking risks and risk sharing between developers, off-takers, as well as governments providing support. And I don't see any difference, frankly, in the emerging hydrogen economy, if you can call it that, but also for other new energy technologies. Here I just give a bit of an overview about what we call the hydrogen equation, but the two columns or the two pillars in terms of the 2050 economic transition scenario, essentially growing energy demand, wind and solar and other traditional, can we call that traditional renewables, filling that gap. But clean molecules will clearly need to play a role. There are simply some sectors which cannot be electrified, and sometimes we hear a little bit of debate pitting electrification against technologies such as hydrogen. I don't think that's necessary. I don't think it's helpful. In reality, where we can electrify things directly, we should do, but there are simply some areas where it's either impossible or unfeasible to electrify, and we do need clean molecules. From an ING perspective and from a banking perspective, clearly there are different end uses for hydrogen, covering the gamut of power, storage, industrial processes, as well as transportation. We as a bank remain agnostic to the various end applications of hydrogen, but we do see certain applications, at least in the short term, being more promising, particularly in terms of replacing existing hydrogen demand with industrial chemical processes. But also we are starting to see more and more projects being developed. For example, it was mentioned by Diego H2 green steel projects, as well as hydrogen as an element within synthetic fuels, and therefore the development of hydrogen within the transportation industry. And here, we heard a lot today, clearly, about regulation within the EU context. I think as far as ING is concerned, and from a commercial banking perspective, it's clearly not our mandate to dictate policy. We are not a market maker, we are a market follower in that sense. We follow the investment and provide finance, but clearly stable and clear policy is very important. I'm pleased to say that I think a lot of the issues that we've been talking about in terms of sort of the delegated act, for example, have started to be ironed out, and there is clearly a lot more clarity within national strategies within the EU, but also at an overarching EU level as to the support and where it's available. And it was also mentioned at the start of the session this morning that we obviously don't exist within a European context, within a bubble. We are competing with global markets, with China, as well as the US, and heavily mentioned the Inflation Reduction Act. I will just close up now with some bankability considerations. I think it was interesting to hear from the EIB earlier on their bankability considerations, and I was pleased to see that there was a lot of overlap in the way that we would approach a project, and clearly there's a lot of alignment there. I've just been talking about policy and regulatory environment. Clearly a stable regulatory environment is important. It's not really, when we're looking at projects, our main focus, other than the fact that we obviously want to be operating in jurisdictions where we don't expect policy to be changing rapidly. We have seen some examples of that as the renewable within wind and solar developed. But clearly our focus will be on jurisdictions and geographies where there is a clearly thought out policy and regulatory environment. Geopolitical risk. I think the good news here is that from a bank which is, and this is no doubt different to other commercial banks who are active in the energy sector, are in the business financing projects which are obviously often are taking place in difficult jurisdictions. I mean, if you look at the oil and gas industry, a lot of fossil extraction is from more challenging environments. One of the good things I think about clean tech finance, and again, I'm sort of focusing more on hydrogen, but I think it goes for the other technologies, is that you can be much more flexible in terms of the jurisdiction where you're producing the molecule in this case. And so again, I don't see geopolitical risk being sort of the main stumbling block in some of these financing, simply because banks have a lot of experience in navigating those issues. In terms of contract and legal risk, this is, I think, the key element that the banks look at. And I think this should be taken as a positive sign rather than negative. The reality is that although new technologies are emerging, there are a lot of uncertainties about them. From a banking perspective, the main focus will be on the contractual framework. And what I mean by that is, what is the contractual framework between the sponsors and the off-takers and the lenders? And whether you're financing oil, gas, wind, solar, hydrogen, it doesn't matter. The contractual framework should remain the same. And I think that as we see these projects develop, and certainly I can speak firsthand, the projects that we are now starting to see emerge, we are seeing that contractual framework being replicated. So my message here is that there's no need to reinvent the wheel from a financing perspective. All the frameworks and levers are there to support the financing of these nascent industries. I think in terms of timing, I perhaps will just close there. The technological risks is an interesting one. Again, just focusing on hydrogen for a second, this is not something that is new, at least in the technology. And actually, if you look at some of the major export projects, I was recently reading about it was mentioned in the press, the NEOM project, which is an export project of hydrogen into ammonia from Saudi Arabia to global markets with their products as the off-taker. There you have a multi-billion project of which almost half of the capital expenditure is the renewable electricity supply. And then a large portion of it is the ammonia production, the Haber-Bosch, which is a well-known technology. And then within that, clearly, you have the hydrogen production, which is indeed the more untested element in terms of scaling it up. But the actual technology there is not new. So again, banks will focus on the technology risk. We expect to have strong counterparties, EPC contractors, and all the rest of it, and expect to have a solid suite of technological understanding in the due diligence. But in the end, these are risks that we are well versed in assessing. I think I will close it there in the interest of time, but very much welcome questions from you all.
Thank you very much, Henry. I think this was an excellent overview. On one hand side, from how commercial banks see the things evolving in the clean energy markets. On the other hand, also you made a bit of an insight for project finance, project assessment, the expectations that the commercial banks have. It's very interesting to hear, and I guess many of our participants today also witnessed that in their applications to the Innovation Fund, that we have tried to set the fund in a way that is very close actually to how you would assess the projects. We always say that we would be tough when it comes to project maturity and preparedness, especially the contractual elements, and the importance, in fact, to be ready once the funding is there, because exactly what you say, money is not the only problem. The issue is whether the project is ready to go once the funds are available. And also on what you said about the need to continue with the public support, for instance, for hydrogen, I guess we will be coming back to all of you in the scope of the year with announcing additional activities under the Innovation Fund, in particular related to green hydrogen auctions that we may be looking at and opening still this year. So still a lot to do, but I think it's nice to see that we are kind of moving together on one hand side, on the policy side, but also on the commercial side. And that's, I think, of quite a long time, a good sign that things are moving. Now, just a quick question, maybe. You outline these bankability considerations that you can also see on slide. Our ambition, our objective is to make sure that when projects come to see us in the Innovation Fund, they are ready, they are bankable. So what would be your recommendation how projects themselves can increase their bankability prospects before actually placing their application?
Yeah, thank you very much. Look, I think I would refer back to what I touched upon actually on this slide here about the framework. The priority for banks is getting our money back that we lend, and the person that pays our money back is the sponsor, is the borrower. So our first consideration is the strength of the borrower and the sponsors. Within that, clearly you have the framework of the offtake contract, and that will be a key element in terms of our assessment. So I think overall, yes, the sort of the technological elements of new energy technologies is clearly very important, but the focus will be on who are our counterparty, who is our borrower, do we believe in them, and do we believe that ultimately they are going to pay us back? It's a simple answer, but it's true.
And I think very, very, very important answer in a way. To be clear who is your partner is the message. Okay. I would now be very happy to open the floor for questions and have a bit of a panel discussion here, really benefiting on the excellence of our speakers today. So first, I would open the floor here in the room. Anyone interested to pose question to our speakers, please raise your hand. Don't be shy. And there is the first.
Thank you. To the North Sea 2 panelists, Mr. Thielen, what was the driver to go into attaching to a wind project a offshore hydrogen generation? What were the drivers? Because it is innovative, but it entails risk where, the core of the rest of the business maybe, didn't need to take that risk.
Good question. Thanks. So and these days I ask myself the same question sometimes. So principally what we saw in the past and how the development is currently ongoing is that there is still a lot of diesel fuel being burned in offshore wind, not for installation only, but then also in the operation of the wind park. So you need diesel for your vessels that cruise around and service the turbines. And you need diesel for the OSS, for the substation in case there's grid outage or similar. So to just get the system still running. So we've seen in the past that first it's environmental not sound to use diesel, and it's a bit odd that we use diesel also when there's no grid and we burn fossil fuel to keep the renewables running later. And that was one of the main drivers. But secondly, also, of course, you're exposed to diesel prices and similar. So if you can create your own fuel in the wind park with the electricity you're producing from a green source, that makes total sense. And that was part of why we decided to attach something with, that merit to the wind park.
Can I compliment François? We believe from energy that in 2030 the electron will be worth pretty nothing. So we better develop industrial modules where we integrate downstream and we create a commodity that has much more value. So we see more and more rest will be within the scope of a big industrial project, but then you create either green iron or green ammonia that have got much more value. Because the green electron itself, as the bankability of the investor, it's doubtful in the next.
Okay, thank you. Please don't be shy and don't hesitate to pose the question to our speakers.
Question to you.
Okay. So let's have a look whether we have questions on Slido. And yes, indeed, a question for Julien. Does batteries types from different EV vehicles represent a challenge for your project?
In very short, the answer is no, but obviously it's a lot of work to come to this conclusion. So yes, the project will be challenged to face a different type of batteries, and we don't know what batteries we will recycle in 10 years' time, but it's clearly one of the challenges. We need to work on that, and we're quite confident we'll be able to recycle different types of electrical vehicles. So, yeah.
Okay, there is a second question.
Happy to have a lot of questions. Okay, let's not go to too many details, but that's a project that will come, let's say, in about 5 years' time. So, because you need time to develop the project, you need to all this, all the permitting issue, obviously. So it's a long-term project, but 5 years' time in our business is almost tomorrow. So, yeah. Thank you for the question.
So 5 years' time. Okay, good. Then we move to the cement industry. I believe there is a question for Torsten. What is the main challenge in the decarbonization of the cement industry?
Yeah, I like this question because I always say to my team, look, when John F. Kennedy announced that he wants to bring someone, by end of the decade, he wants to bring someone to the moon and bring him back to the Earth safely, he knew that it is quite difficult to build the rocket and to bring them in safe and back. And so you have to invent a lot of things. So this is a challenge we have as an industry. And I tell you, the challenge is really big. But nobody told him, so if you do it today, that you need 1,000 or thousands of permissions. And guess the answer when somebody asks you the question, so if one person is on the moon and comes back to the Earth, how can we do it? Because nobody was on the moon before. So these questions will be answered if they, for example, tell you we have to build a CO2 pipeline, and the local authorities, they need legal certainty to approve a CO2 pipeline, which is part of the project. So we need regulations for this, a lot of regulations, and at least we need the people, the local authorities, which is really important. They want to make it happen, but they need legal certainty to approve this, to give final approvals to thousands of things. And this is really important for us. I think we can make it happen. I'm an engineer. I'm really I'm a believer that we can make it happen technically. We will get financed, everything. That is something which is not the obstacle, but permission and on time will be on permission. That will be the topic.
Yeah, we've heard about that also in the morning session, into looking into how the permitting processes can be made faster and less cumbersome. So let's see how this. But I guess this is also the point that is important for project promoters themselves. That actually, when you are in the planning stage, you already embed those considerations well in your plan, so that then you are not surprised when suddenly your project gets delayed. Okay, then moving back to the offshore wind sector, what other emission savings can we expect to come from offshore wind in the future?
All right. Again, question from this very active person. So, well, principally, I guess what we see in wind generally, but in offshore wind in particular, is that size matters. So the turbines get bigger. So now we are deploying 50 megawatts, and that alone means that we need less steel, less components, less traveling, less installation. So I think the main emission saving factor is really that these plants get bigger and you can generate more power from just one asset. But in addition, I think what we are doing with the hydrogen, still call it an innovation or experiment, will be the future. There's no way around it. We see that also in the supply chain. There's people trying to implement hydrogen solution to just bring the amount of emissions down on the supply chain up to the wind park in the end. So I think it has just started, and we are part of it and thankful for it. But in the future, offshore wind will produce green, but also be probably produced green.
Maybe can I have one complementing question that kind of goes around my head when you look to, you have two parts of the equation. One is we do need massive increase in hydrogen, in green hydrogen production, so electrolyzers that will consume a lot of green power. On the other hand, we have projects like yours that actually increases the sizes instantly, because what we have seen is exponential growth in the capacities installed. So how do you see this equation going forward? The connection between the power installed and the demand, especially for hydrogen, are they kind of in tune? Do we still have a big discrepancy out there? How would you see the renewable energy power sector addressing that particular demand?
Well, principally, I think both sectors are expanding rapidly, and it's great to see that they're also interacting. At least for Germany, where we are active, I can say that the bottleneck is a grid, actually. So we produce power, but we are also curtailed because the grid's not capable of transport the power to where it's needed. And if there's a hydrogen plant somewhere in the middle of Germany, it could be that can't even benefit from our power from the north because the grid is not available. So I think one of the major challenges for the future will be to not only have the wind parks operational, but then also build the grid to bring the power where it's required for hydrogen production.
Okay, thank you. Let's look to Slido again, and I believe there is another question for Julian related to batteries. Any best practice to achieve a competitive cost efficiency of GHG for the ENFU and the cost efficiency of the business when sizing plant?
I believe INFU means innovation fund, right? Or anyway. Anyway, it's a good question about the sizing of the plant. As I said, we are in a market that barely exists today. It's going to be huge in 10, 15 years. So it's really a question we ask ourselves in this project is what the right sizing, because obviously, like my neighbor here, the size matters. So the bigger you are, more or less, the more efficient you are. But again, if you do too big at the beginning, then you run the risk to have an empty plant. So that's the, we made a choice based on our analysis of the market and the sizings in terms of engineering and so on to be the most efficient. And we presented this project. Again, the support is really needed at the beginning. To start it at the beginning, it's probably a bit more difficult. And then if things go well, which I'm quite convinced, then we can duplicate the plant and build new modules of additional capacity. So that's how we do usually. But that's maybe we have to meet again in 5 or 10 years to see that. But that's how we do things. But that's a very, very good question.
And I guess we are very happy to meet again.
Yes.
In that time. Diego.
If I can complement for the question, today is not about waiting for the end of life of the batteries. Today we have enough scrap, we had enough recycling sites up and running. Today, a black mass out of scrap production is leaving Europe to be treated elsewhere. Today, January 2023. So the sooner, the better. Because there's not better feedstock for recycling than the scrap of production.
Yeah, that's a very, very valid point indeed. As I said, we're already struggling to have enough metals in Europe, as we said, and it's a pity that we'll send back the materials to be recycled outside of Europe. So that's really a key issue, and we are all convinced that once you have the metals in Europe, we should keep them in Europe, keep the value, keep the jobs around that, and Eramet is really committed to allow that. Yeah.
Yes, and we have seen that in many innovation fund project applications. In fact, the scrap material, keeping the material within the chain recycled, if possible, endlessly, which obviously leads to high efficiencies, better unit costs that we all want to achieve. Diego, I believe we have one more question for you.
Yeah, so thanks for the question, because it's fully aligned with Europe's strategy with what is called the famous strategic industrial value chains that were identified like 3 years ago, if I recall right, 14, were mandated to lead 2 of them. So all those non-financial aspects about regulation, about skills, about permitting, about supply chain, all of them are addressed systemically in those strategic value chains that some could call industrial policy. I don't know. For me, it's just purely business policy of securing that those industries are thriving in Europe. But again, Europe has got there, and the solution already kicked off 3 years ago.
Okay, now we have, I believe, a question that could be posed to Henry. You have done quite a bit on hydrogen projects, how you see them. So what do you see are the main challenges for green hydrogen projects to secure long-term supply and offtake contracts? What is your experience so far?
Yeah, it's a very good question, and it's a difficult question. And as a banker, I'm not sure whether I have all the answers. But what I can say is the experience that we've seen, and I think that I go back to the comment which I made about risk sharing. Now, we are starting to see long-term offtake contracts being agreed, or at least in the final stages of being agreed, and there is a balance to be struck between, should we say, shorter long-term contracts of 5 to 10 years, or sort of long-term contracts of 20 years, and clearly there'll be a sliding scale in terms of the price that is taken within that structure. Now, what I can also say is that I think there will need to be at least initially some flexibility in terms of those contracts. And what I mean by that is what we are tending to see is that there will be a majority fixed element of that long-term offtake contract where there is a price discovery which is based on the cost of production, and then a minority part of that offtake contract where there is you get the benefit of the market essentially, and that can be split between producer and offtaker. It is a very, very difficult question to answer because we are particularly as far as hydrogen is concerned, at a moment of price discovery. What do you price hydrogen on? Do you price it against cost of production? Do you price it against conventional fossil fuels, which is slightly strange given that we expect fossil fuels to be phased out over time? And that is what is happening at the moment. But certainly I would say the main challenges are to share that risk between counterparties and have flexibility in terms of fixed price and variable price on the offtake.
Sorry, to give a flavor, because Henry, you know that we are both together in National Green Steel, and the order book is pretty strong for many years. And why? Because we're not touching about the cost of the molecule, we're just the off-takers is green steel off-takers. So at the end, the premium of green steel on a car is 1%. So the off-taker of the green steel doesn't care that much about the molecule price. They care about what is the impact on the product that they sell. If we go to green fertilizers, the same. And the impact of green fertilizers in the loaf of bread is negligible, 0.0001 euros. So I think that debate should not be on the price of the molecule only, but should be on the premium of the end product created by the green hydrogen. And there, you said, Roman, about the CFDs on green hydrogen. Our strong suggestion is that the CFD should apply for the end product rather than the intermediate molecule going forward.
Thank you, Diego. And maybe just before moving to, I believe, our last question today, Henry, it is very interesting what you were mentioning on the sliding effect of the term of the offtake contract. But from your perspective as being ING, being commercial banker, having seen many of these green hydrogen projects, what would be at least the minimum period where you would expect the project that would be bankable from your end to fix?
I'm going to do my best to not provide a politician's answer to that question. but it will depend, and I think actually to Diego's point, and I totally agree, by the way, because there are certain applications clearly where the premium on hydrogen is not seen so much in the end product. That doesn't apply perhaps in other aspects, for example, where hydrogen is used as a transportation fuel, where it is the main cost. But I totally agree with the point, and that's where we are indeed seeing some of the most promising projects, where the cost of hydrogen is one smaller element of the overall cost of the value chain. In terms of your specific question, Roman, I think that as part of a project financing, I would refer to the nascent project financing within the LNG industry at the start, where you were having to see contracts which were in the region of 10 to 20 years to provide a sufficient period of time for debt to be repaid in a reasonable cost of capital environment for the producers, for the sponsors. But we would expect that to decrease over time as it becomes, as price discovery increases and it becomes a more commoditized market. And you see very strong parallels with the LNG industry, where at the start it required long-term offtake contracts to make it financeable, to make it bankable. But whereas today it's a majority spot market and banks are willing to provide shorter-term mini-perm debt.
I think it's logical answer. The more commoditized, the more traded, the more discovery you have. Okay, let's move to, I believe, our last question, unfortunately, for today. And I believe this is for Torsten. Again, how do you deal with the fact that CO2 used in short-term CCU applications, including methanol production, that is used for, let's say, fuels, so that it's burned and then released to the atmosphere, is not deductible under the EU ETS?
I think, yeah, that's a good question, because I think it's, first of all, it's a mistake what we see at the moment, because, as I said, we have to, first we have a huge demand of methanol in the future, so the methanol demand is there, and we have to ramp up the circular use of carbon in the future in the chemical business. So we need this, the carbon, and therefore I think it's also a short-term perspective what we see today if we are not dealing with this, because methanol is only needed for a period, and if we are not able to deduct it, that is a financial burden for us, and that means also that it is not really showcasing for others to say we go into the same direction. So that's why I hear today a lot of storage solutions coming up, which is fine, and I know that we need storage, but I think we are missing the opportunity to transfer really our chemical business into a carbon-used business, into a carbon circularity. And this we really strongly, we have to change, because it is really a short perspective, which is said, okay, the CO2 captured is then released. Yes, but if I'm living in Hamburg, and if I see, for example, a ship today burned with crude oil, it is also that this is really, that is dust, that is the emissions coming out, it's not only CO2. So it is a super advantage if now ships are built with burning methanol in the future than burning crude oil. And therefore we really have to incentivize this, that this is possible and that we are able to deduct this.
Thank you, Torsten. And I'm really sorry, but we need to close the session. I see one hand raised.
Jan Secker, representing the chemical industry from Perstorp. I just want to thank you, Torsten, for that comment. I mean, I think I don't doubt for a minute that anybody in this room doesn't know and understand that decarbonization is by definition an oxymoron. We don't want to decarbonize. Everybody, to live the standard of life that we live, we need carbon, but we don't need carbon dioxide in the atmosphere, and so it's so important that we drive project and incentivize those type of projects where we actually do produce the carbon atoms for the chemical industry and then have a recyclable end-of-life handling. That's the direction we want to go. So just wanted to make that comment. Thank you very much for that.
I think it's a very, very pertinent comment, by the way. Probably we should rethink our vocabulary, because essentially we are talking about recycling of carbon. or carbonizing in a way in industries where this carbon is becoming clear and necessary for so many clean tech, as we've heard today. So this brings our session to close. Let me thank wholeheartedly to all our speakers today. We've heard that clean tech investments indeed represent important potential for competitiveness of our industries, that in the right constellation, these projects can be brought online relatively fast, that the EU needs to speed up its response to stabilize the space in the clean tech, and that the solutions are out there. But we need to connect, we need to talk, we need to learn from each other and inspire each other, and I hope that the speeches from these sessions did so. And now let us move to our last but not least, and very important session of today. It is also a symbolic act that we will now witness the start of 16 large-scale clean tech projects here in this very room. I would like to pass the floor now to Kurt van den Berge, who returned to us. I'm very glad for that, for his short introduction.
Thank you very much. Thank you very much, Roman. Colleagues, ladies and gentlemen, friends on this route to clean tech future. Thank you very much for being here today, for participating in this debate. Alex and I were able to witness a little bit the last debate, which I think was very instructive. I certainly picked up a number of messages, including on the need for a stable regulatory framework, and also the role of carbon and the oxymoron of decarbonization. So these are all messages we take to heart. I think one of the benefits of such a day as today is that there is a very good mutual learning between the business world, the innovators, entrepreneurs, but also the policymakers. And I strongly believe that thanks to this kind of dialogue and exchange of views, colleagues in the European Commission also become policy entrepreneurs. They become more knowledgeable about what is happening in the business, in your marketplace, so that we can also help you in ensuring the success of your projects. We now move to the signature ceremony for the outcome of the second large-scale coal projects call. I am very pleased to be here with you today. I have the honor of leading this signature ceremony. All of you have moved a long way from the initial project ID to submitting the application and then the whole evaluation process, which, as I said this morning, can be frustrating. But I assure you that the very competitive element of this process means that we have a lot of confidence in your projects. Even if we know that we can and will wish you every success on your road to delivery, you will probably face a lot of hurdles, a lot of challenges. And that's natural. When you try to break new ground, things happen that you didn't want to see happening. But we will be there also to walk with you and to learn from you how you face these challenges, what challenges you face, how you overcome them, so that we can also internalize this in our policy making for the future. So I would like to thank on this occasion also all the colleagues in DG Klima and in CINEA for having organized this whole process of the call, the evaluation, and the ones that will still be coming. We are very pleased of the cooperation with CINEA. It goes wonderfully well, as today's conference have shown. We will be following you all in your projects. We believe in you as trailblazers of the clean tech future, the story of which will also be written in Europe. And it's thanks to projects like you that we have the faith and the trust that this indeed will be the case. So thank you very much for this. And I believe we can now invite the first 5 signatories. I'll leave to Paloma the rest of the ceremony.
Well, we are almost there. But before calling the the 16 projects who have received. Yeah, I'm much shorter, so that's the problem. You know, we have to move up and down. I just want to thank you for being here. I only want to echo as well the words of Kurt about the good cooperation between the European Commission and CINEA in the implementing of the Innovation Fund, because these projects will substantially contribute to reduce the EU greenhouse gas emissions. We are working very closely with the Commission. We are working very closely with all our partners, and we hope that we'll make a success of the European Green Deal. The awarded projects will bring other environmental benefits to the European economy and support our strategies related to the hydrogen, sector integration, and circular economy. For example, the awarded projects will advance decarbonization solutions for energy-intensive industries, such as carbon capture, use and storage for the cement industry. We will promote also sector coupling and indirect electrification through green hydrogen production and hard-to-electrify sectors. These projects also will support the application of circular economy and energy efficiency principles through, for example, recycling material residues and use of heat that would otherwise be lost, and through the cooperation of different industries. These projects also support the replacement of fossil fuels and the deployment of innovative renewable energy capacities, such as wind energy, solar energy, and geothermal power. And finally, these projects will also bring social and economic benefits, such as enhanced growth of new sectors, creation of quality jobs in the green transition, support for local economies and cooperation between different industries. And they will lead as well to specific economic benefits. For example, by lowering prices of new technologies and products and creating new markets. The Innovation Fund, therefore, can help address the social and labor markets aspects of a fair green transition. As announced this morning, our visual artist, Mattia Sugamiele, has in the meanwhile completed his artwork. I would like to pass the floor to Anna Vittoria Magagna, art curator, who will enlighten us about the insights of Mattia's work today. Please.
Good evening, everyone. I'm Anna Vittoria Magagna, art curator. I'm proud to be here today representing one of the most promising artists from Italy, Mattia Sugamiele. We also want to thank the European Commission and CINEA for the invitation. Sugamiele's work is based on the reflection on innovation, new technologies, and our relationship with the digital world. Maybe we can see the artwork on the screen so you can all see it, or maybe you can see it later. Okay. Today he worked on his artwork named Gaia, from the ancient Greek name of Earth, to celebrate this important moment for the constitution of the Innovation Fund. The artwork is a hybrid composition between digital world and the physical one, resembling also our lives in contemporary times. On the canvas, you will see elements which are painted digitally or created with artificial intelligence. For instance, the background, which is a sample of the surface of the Earth, mounted by a stylistic European flag, which stands, of course, for Europe and signals its role as gatekeeper for the environment. On the other hand, the creation of the physical work, which you witnessed in part today, employs painting and gestural elements. It plays with the light and shades of color, also referring to the digital world. For instance, imitating the nuances of the normal mapping or the three-dimensional objects. The whole composition appears fluid in the end, with both digital and physical elements, and it refers to the mangroves habitat from the famous metaphor of Luciano Floridi, one of the most important philosophers of our times. Mangrove trees are particularly capable of absorbing a lot of carbon emissions. They are force for nature, just like the 16 projects here today signing this important grant. They are a piece of art themselves under a different point of view. Floridi says that the mangroves live in brackish water, where rivers and sea meet. If you look at it from the perspective of fresh water or salt water, it is an incomprehensible environment. Our life is like this. The barrier between real and virtual is fallen, and new technologies are part of our lives. This is where Mattia Sugamiele's work stands, and which we wanted to share with you today. This artorgia resides in the space where transformation happens, where humans can advance and innovate with attention to sustainability and in communion with our Mother Earth. Thank you, everyone.
Well, thank you for this fascinating artwork representing the path towards carbon neutral energy system. The reproduction of this artwork with the signatures of the people will be sent to the companies as a good memory, I hope, of this important moment. And now it is the time for the first group of project representatives to sign symbolically the grant agreements by signing on this whiteboard on my left-hand side. I now invite Anna Mascolo, Executive Vice President, Emerging Energy Solutions Shell, representing the Hydrogen Holland project, Mercedes Alonso, Executive Vice President, Renewable Polymers and Chemical Neste, and Marco Corbenranta, Executive Vice President, Oil Products Neste, representing the Pulse project, Benjamin Midlin, Managing Director, Nord Stream 2, representing the N2O-WBF project, Roger Missen, CEO of RWE Generation, representing the FUREC project, and Virginie Dechassey, Chief Sustainability and External Affairs Officer, ERAMED, representing the Relief project, to put the signature on the whiteboard and then join me for an individual picture.
Different paths. Yeah, that's colorful, right? Switch it, black and blue.
That was too fast. Just pretend.
Pretend you're signing, please. Great, thank you.
Group picture together.
Now, the second group of project representatives can sign also the whiteboard, and now I invite Thorsten Hahn, CEO of Holcim, representing the C2B project. Thomas Skadal, CEO of Biosyn, representing the Biosyn project. Ernest Gelito, member of the Management Board, Heidelberg Materials, representing the ANRAP project. Eda Sif-Pin Aradotir, CEO of Carvis, representing the Coda Terminal project. And Jan Seher, CEO of Berstoff, and Axel Whitfield, CEO of Uniper Hydrogen, representing both the air project, to put their signatures as well.
Picture together. Thank you.
Okay. And now the last one, but not the least, ones. I invite the final group, and I invite Andrew Murphy, General Manager, New Fuel Cells, representing the High Skies project. Pascal Vinet, Group Vice President, Air Liquide, representing the Alligator project. Robert Gabrochowski, CEO, North Systems Poland, and Emma Endeux-Leven, the Director of Business Control Battery System, representing both the North Star Plus project. Xavier Guénou, CEO of Lafarge Siemens, representing the GO4 EcoPlanet project, and Jean Chantecler, Vice President and Manager Director, Lloyds Southern Europe, representing the CAL-CC project, and Robert Winslow, Director of Ivor Enderverme, representing the Ivor Loop project, to put their signature and then join us again for the final picture.
it's okay. It's okay. Thank you.
Well, thank you all who are present today in the room, as well all those who are online for the interest and participation. You know, I hope you have enjoyed this event as much as I did. Discussions were indeed extremely interesting, with a lot of ideas that will help us to bring clean technology to the market. I would like to thank especially all the speakers, the artists, and my colleagues for the smooth organization. Now the event is closed, and now I invite all representatives who have just signed to join Mattia, Kurt, and myself for a family picture in front of the artwork. We will do this in the entrance of the meeting room. So thank you again. Hope you, those who are going back home, have a safe trip
To
back.
meet today's energy challenges and become climate neutral by 2050, we need to speed up the clean energy transition of our economy.